Hello, everybody. Welcome back to another episode of The Market Close. It is Thursday, August 1st, 3:45 p.m. We have Apple and Amazon on deck in the next 15 minutes. We will get their numbers. We also have Intel, Coinbase, Roku, Twilio, lots and lots of companies to get to. But before all of that, how's everybody doing? This is it's a tough day. It's one of those days in the market where it's a tough day. The stock market is down. It is red. We are seeing red across the board. Very few stocks I'm seeing have a little bit of green to them. Meta has some of that green because they crushed earnings, but they were at 525 on the day. Meta, let's see, 527 on the day, and they have come down precipitously from that. On top of that, you've got CrowdStrike down another 4%. You've got ARM down 16.8%. They were down 9% yesterday after hours. As the market collapses today, they go down even more. Robinhood's down 2%. Robinhood got to 1983 at one point. Robinhood back above 20 bucks at 2012, but Robinhood is down $20.12 right now, down 2% of the day. It was down even more. Tesla is at 216, down 7%. The S&P 500, it's down 1.63. That's a lot. It gained almost 2% yesterday. It was down a little bit more at 1.539, but that is down. Nvidia, which gained basically 14% yesterday, including after hours, gave up half of that, and now it's down 7.85% back at 107. Nvidia bottomed at 100 a couple days ago. Now it's at 107. SoFi is at 7-Eleven, 11 cents away from going below $7. Intel below $30, down 5%. Apple down about 1.79%. Roblox down 5.68%. Carnival Cruise, the cruise lines have not been safe. They are down 5.6%. And everybody's favorite, the Russell IWM, that is also bleeding, down 3.29% on the day. One thing that's really red, some of you guys might have not seen this, semiconductor index, the entire ETF for semis, SMH, is down 6.7%, which means when the ETF is down, if you look at the left-hand side of my screen, all of the semi names will be down. AMD down 8% after their monster earnings. I thought they had a pretty good earnings. Broadcom's down 8%. Qualcomm's down 9%. Taiwan Semi down 4%, which is a little tame to ARM being down 16%. Lam Research being down 9%. Dell, $8 away from going below 100. And then Micron, basically $1 away from going below 100, down 7.8%. So it's a tough day. It's a tough day. I mean, there's nothing more you can say about it. I have some perspectives for the bull case and the bear case. I want to first explain why we're having a tough day. Let me first break that down for those that are confused, why things are going so bad. And then we'll get into the bull and bearish take that I have on the broader market. Real quick, Les Robertson, thank you for becoming a channel member. Really appreciate it. Shout out to Les Robertson. Thank you for becoming a channel member. Okay, why is the stock market down today? And again, we got Amazon and Apple in about 10 minutes, so we'll get into them. 3 reasons. Number one, initial jobless claims. This morning, they were up 249 versus 236. So we had 14,000 more people filed for unemployment. That is not good. And obviously that means unemployment is rising, which means the labor market is continuing to weaken, which is consistent with some of the data we got over the past couple of days. Number 2, ISM manufacturing came in at 43. This number simply means that we are contracting, not expanding. If we're above 50, we're expanding. Below 50, we're contracting. The estimates were 46. Not only did we come in at 43, but this is the worst since June of 2020. What happened in June of 2020? Well, we entered, or we were a couple months into a global pandemic. And as a result of that global pandemic, manufacturing slowed down, right? Because companies shut down. So from that perspective, we are seeing the economy slow down in certain parts of the market, particularly ISM manufacturing, the worst since the pandemic. So that, I think, is really this number. If I had to sum up, why the market's red, it's this number. I mean, this number is not doing well for the market. And really, we saw a sharp downturn at around 10:30 a.m. after the markets digested this number. And then finally, companies like Hershey's and Wayfair today said on their earnings that the consumer's in a bad spot. They flat out said the consumer is not spending. And if you take that for what it's worth and you believe them, you put that with Starbucks, Nike, McDonald's, some of the Lululemon, some of the other companies that are saying, hey, we don't like the consumer and the position they're in as well, then you've got to believe there's at least enough weakness to the point where earnings will be affected. That's why stocks go down, because people sell them off because they essentially feel that they won't be able to produce future growth and earnings. Therefore, they take their profits or they take their losses. If you believe the consumer's in a bad position, you probably sell some of these stocks because you don't think some of these companies will be able to put up the numbers that they're putting out. So the kind of thesis defining argument here is that bad news was good news 7 months ago. Bad news was bad. Or sorry, bad news was good because like when the economy slowed down, that meant inflation would slow down, which was a good thing. We wanted to see unemployment. The Fed wanted to see people not have enough food to buy a meal at McDonald's, which is why McDonald's just introduced a $5 meal. The Fed wanted to see people not be able to get a $6 coffee. The Fed wanted to see people not be able to buy a Reese's peanut butter cup. The reason the Fed wanted all of this pain to happen is because they had a mandate to make sure inflation comes down. And in order to make inflation come down, you have to have growth to slow down. So what's happening right now is exactly what the Fed wanted to see, which is why bad news over the past 7 to 8 months was good news. It was really good news because that means that we've seen a growth in the economy, which would ultimately get inflation to come down. Now we're getting to the point where, look, inflation has come down and bad news is actually bad news. Like if something goes bad, that means, oh, the consumer's weakening, the labor market's weakening, people don't have enough money to buy coffee. That's going to hurt Starbucks earnings. That's not just going to take down the price of coffee from an inflationary perspective. That's actually going to stop people from spending money. And what is an economy? It's goods and services being circulated. If goods and services aren't being circulated, then you don't have productivity, you don't have growth, you don't have GDP growth, and you don't have an economy that's thriving. So bad news, I think today you can officially say it's bad news. If the market went up today based on the bad news that we got, technically the market would believe that inflation is still too sticky. Therefore, we need to get inflation to come down. The fact that the market went down on this news, I think it's kind of healthy because they believe that, all right, inflation's coming down. We don't have to worry too much about inflation. The next thing we have to worry about now, S&P 500 right here at 543, seeing a little bit of a recovery from 539. So people did buy the dip, not that aggressively, but people did end up, it seemed like we put in an intraday bottom at that 250 timeframe roundabout. So about an hour ago, it seems like stocks bottomed, at least for today. Now the fundamental question is, when is Jay Powell cutting? When is Mr. Jay Powell cutting? Because we need Jay Powell to cut in order to stop the bleeding. Just to summarize again why a cut is so important. When you cut rates, and I don't even know if 25 basis points is going to be enough by now. When you cut rates, mortgage rates come down, automotive insurance comes down, personal loans come down in terms of the APY you have to pay on them. Everything starts to come down when rates go down. This is what we saw in 2021. And when rates go down, asset prices start to get inflated because that 5.5% yield you could get on your money, that also goes down because the Fed is not going to be paying you 5.5%. By the way, speaking of money market funds that people have been getting, we just got new money market fund data. August 1st, total money market funds decreased by $10.65 billion. This is 2 weeks in a row that we have seen a decrease of $10 billion. We went from 6.15 trillion to 6.13 trillion. Why are we seeing a decrease? I think it's not really to buy the dip. It's more so because the market knows, okay, rates are going to come down. We have to get our money outside of money market funds to be able to collect yield somewhere else. So when rates come down, that is good for asset prices in the stock market because you need to find yield in another way. The biggest issue is if the Fed is cutting rates into a weakening economy to the point where even if you put mortgage rates they're at 7%, let's just go crazy and say they're going to be at 4%. That's not going to happen, but let's say that does happen. And people still don't have the disposable income or the labor income to buy a house or to finance a house at a 4% 30-year fixed mortgage, then we're fucked, right? Then we're just completely fucked. So the fundamental question here, yes, geopolitical tensions. I didn't mention that because honestly, I just haven't been looking at that much because I've been looking at other data, but 100% Iran, Israel, a lot of stuff going on there. That is geopolitical. Also, real quick on this geopolitical stuff, in terms of domestic politics, the betting markets are officially pricing in a Kamala victory. I know that's crazy, but I'll share that data later. They are pricing in a Kamala victory. A Kamala victory is not friendly for crypto, which is why crypto is down, and it's also perceived as not friendly for the market. So I think that could be geopolitics and domestic politics, another reason why the market's down. At the end of the day, if the Fed is cutting into a recession, like a real recession, the cut's not going to matter. Like no one's really going to care. If the Fed is cutting because they did their job, soft landing, inflation's down, and now they're just quelling some of the consumer weakness, then things are going to be okay. But I think we've yet to figure out which one is that because we don't have enough data. And once we do get enough data, we're going to know if the Fed was late, like they were in 2021, or if the Fed is right on time. And hopefully they are right on time. Real quick, before we get into the market close, I just want to share a couple of bullish perspectives. Now, I'm not going to go through this entire tweet because I pulled a Bill Ackman here and I read a lot. I'm just going to quickly say the headlines. 5 reasons why I think being bullish is still important. I did not sell anything, by the way. Let me disclose that. Did not sell anything. Did not raise cash. Let me know in the chat if you raise cash. I do think this is a day that retail tends to sell because they get super afraid and they want to keep their profits because, they want to keep something. I am more bullish on the economy. So I have not sold anything. I didn't buy the dip today either, but I bought the dip yesterday. I bought a couple of options on Robinhood, but outside of that, kept everything the way it is, and we'll evaluate in a couple of weeks to see what's going on from there. Okay, 5 quick bullish headlines. Number 1, there's still 8 million jobs open. If you don't believe that number, take away a million jobs. There's still 7 million jobs open. Although unemployment is rising, jobs are open. Number 2, big tech is putting up gigantic numbers. Advertisers are still playing. The cloud is still growing. Big tech has not shown the looming recession affecting their numbers. We'll find out with Amazon and Apple after the bell. Number 3, banks are cutting rates. So again, the Bank of England cut the rates today. I think the Fed will follow along with Canada and the European Central Bank. Number 4, GDP growth was at 2.8%. Remember, a recession is defined technically as 2 quarters of negative GDP growth. We are not in 2 quarters of negative GDP growth yet. And by the way, I think we'll figure out if we're going to get close to 2 quarters of negative GDP growth because, for example, Q1 of 2025 will say we're only growing 0.5% or 1%, or we'll get closer to that negative number. We're well above that right now. So that's another hedge against this whole idea that we're going to get into a recession. And then finally, AI. I'm not going to go super deep into AI, but I believe AI is real. There's a lot of use cases for it. I think Apple and Amazon are going to talk about it. We don't know all the use cases that are monetizable, but there are real use cases. And that is a secular tailwind that I do not think is going away anytime soon. Therefore, I still think there is an argument to remain a little bullish. Let me put in Josh Brown's perspective before we get into the bell. And then we'll get into Apple, Amazon, Intel, Coinbase, and all the big earnings for today.
There are some who would suggest just don't fight the Fed. A rate cutting cycle is just good for the market, just like a hiking cycle is bad. Nothing else really matters. The only problem in this case is if they're late and cutting into a fast weakening economy, which puts a lot of stocks in a little bit of a dicey zone.
Yeah, so definitionally, the Fed is always late because if you're data dependent, then the data comes in and tells you, hey, you're too tight or you're too loose. So we know they'll be late. It's an issue of degree. How late? I don't think they're so late, and I don't think that a quarter basis point rate cut is really going to affect anything in the real economy. It's not like they should have moved in July. Okay, let's say, for argument's sake, they did 25 basis points yesterday. Still got bad data today. Not bad data, normalizing data. Whatever they do today won't matter probably for months, and they would have to do a succession of cuts for it to actually be felt. If you didn't take away this lesson from the last 2 years, then I don't know what you're paying attention to. The Fed cannot move things around with rate hikes or rate cuts or even staying pat in the near term. They can change sentiment, maybe, but they definitely can't affect hiring, affect prices, affect wage growth. They have no ability to do that in the short term. So I don't think it's the end of the world if they're early, late, a little bit late. It's too late that we have to worry about. This is not that, and I think everyone should just take a deep breath. I want to just chime in on Meta. I think Bill's got a great position on his hands here.
Okay, so I kind of agree with that perspective at the end of the day. I do think that it's not the end of the world. I know not everyone, but people are acting like it's the end of the world. I think there's a lot, this is one of those days where you have to remember your overall thesis. And my overall thesis at its core is that we are in a bull market, and we're in a bull market for a reason. And that reason I just defined all the 5 things that I talked about. So if I believe in that, I would need a lot more data to fundamentally flip, right? And personally, I just don't see the data as compelling as a reason to flip, especially with the Fed having an ace up their sleeve, which is cutting. And if things really get that bad, they can cut by 50 to 75 basis points if they need to. Maybe that doesn't stop a recession, but that definitely means you don't need to sell your stocks at a bottom today if we have a bit of a rally for even 60 to 90 days as we are in the rate cutting cycle, and then we have a collapse. So I do think there's better moments to exit if you think everything's hitting the fan versus, before the Fed even cuts. And so that's kind of the perspective I have on it. But today, Amazon and Apple are really going to show us what's going on. All right, let's make our list. We have Amazon, we have Apple on the watch list, we have Intel, we have Coinbase. I think we have Square. Let me know if I'm missing any of these. We have Roku. we have Twilio, we have Mercado Libre, and we have a bunch more. I'll put more even there, but Amazon and Apple, those are the ones we're looking at. I think Amazon comes out quick. Apple might take 10 minutes. Let's see what we got going on. Thank you, everybody, for being here. August 1st, 4 p.m. The stock market is now closed. All right. Thank you for this, Tejas. So 4 p.m., we should have Amazon. So we should have Amazon quick. That's the one we're looking at. I am bullish on Amazon. I think their operating margins will go up, and I think they will do well. I could be super wrong. I don't have a position in them. But I think Amazon does okay. Maybe Amazon shows some weakness in the consumer. That's possible, but AWS is what prints the net income. So that's really what we have to look at. Okay, so all eyes on Amazon. DraftKings as well. All right. I actually like DraftKings, but let's see. No position in that one either. They got hit from some regulations last month. All right, Amazon. I don't have the numbers yet, but I have it loaded up in case I get the numbers ASAP. Amazon up a little bit after hours. No real movement yet. Derek said, let's bet. No, we're not betting, Derek. Goodness, I should have took the bet yesterday. Oh, Amazon's down. We're down 2%, folks. We're down 2%. We're down to, no, now we're up. Now we're green. 2% green. Now it's gone. Now it's flat. Now it's down. Now it's green. 0.02%. Now we're red. Now we're 3% down. 3% down. Recovering a little bit. You see the red. Oh, Intel, by the way, down 5%. Intel's down. Amazon is now 4% down. Amazon is red. Red Amazon. Amazon went to the Amazon forest and got its head chopped off. Amazon down 6%. Is this an overreaction? Is this a head fake? What do you guys think? Is this an overreaction or not? What did you guys say in the chat? I put the poll. 60% of you said pump. All right. Well, so far it's not pumping. Down 4%. Let me see if I can get the numbers. If you have the numbers, put it in the chat. If you have the numbers, let me know. No numbers yet on my side. I should be getting the numbers really quick. Hold on. I should be getting them really quick. Okay, so I got it. Net sales increased 10% to $148 billion. Operating income of $14.7 billion. Net income of $13.5 billion. AWS increased 19% year over year. Now, I need to see the beats. I don't know if those are beats yet, but those are the raw numbers. Are we still down? We're down 4%. Recovering a little bit. Intel, by the way, getting schmacked. Intel down 10%. Apple, no numbers yet. Everything else is basically flat after hours. Squares is up a little bit. Coinbase is up a little bit. Amazon's the big mover right now. Intel gave terrible guidance, which makes sense. Intel probably was going to give terrible guidance. No. Okay, here we go. EPS beat 126 versus 104. You beat by 22 cents on EPS. AWS 26.3 billion versus 25.9. They beat on AWS by about 400 million. And then revenue, they missed by $1 billion, or sales, they're calling it. They missed by $1 billion. The street wanted 149. They put up 148. Maybe that's why it's falling initially. I don't know if that's enough of a reason to take it down, dude. I don't know if that's enough of a reason to take it down. Kind of feels like an overreaction. Oh, MicroStrategy is today. Okay, let's put MicroStrategy. MicroStrategy slightly down right now after hours. Intel's getting destroyed right now, down 10%. They're down 15% now for the day. Amazon now down 6%. Okay, so unfortunately, we're not seeing the move to the upside on Amazon. I think oh yeah, they did miss on revenue. They did miss. Yep. They missed on revenue by $1 billion. Yep. They missed on revenue by $1 billion. They missed by $1 billion on revenue. That is confirmed. Now, yep, there you go. Oh my God. Look, I don't think that's that big of a deal, but the question is, where did they miss? Why did they miss? What did the street see around the miss? Is it in cloud? Because then we got an issue. Is it in if it's in retail, then folks, the consumer is weakening. If people aren't buying on Amazon anymore, the consumer is weakening. So let's see. Let me pull up the numbers. I'll put up CNBC right here, and let's get some more clarity. All right, here we go. Here's Amazon. Let's see.
And it was a beat on EPS, a slight miss on revenue. I'll get you that EPS number, $1.26. That was better than expected. revenue of $147.9 billion. That looks slightly light here. And then, guys, it looks as well like the Q3 revenue is a little bit light at the midpoint of the range, 154 billion to 158.5 billion. Street was looking for 158. And then same with operating income. If you look at the guidance there at the midpoint, it's lower than the Street expected. I want to get you that AWS number. This is key. It was a beat, 19% growth in the AWS.
Okay, so AWS beat. At least that's okay. Amazon recovering just slightly right now.
US sales segment better than expected. Street was looking for 17.6% in terms of growth. Couple other segments here. North America up 9% year over year to 90 billion, and then international up 7%. Stock down more than 6% here. You can see on the weaker guidance, most likely though, down more than 6% after hours. Guys, back over to you.
Okay, Kate Rooney, thank you. We'll come back to you as you get more in that report. This third time's a
Okay, so Mercado Libre is up. Apple is at, wait, is Apple out right now? No, Apple's at 410, right? Apple's at 410, I think. I'll have it listed. We'll see a move in the stock if it moves. I think Apple's at 410. But Mercado Libre, they're up 7%. So congrats to shareholders who have that one. I'll pull up their numbers in a bit. MicroStrategy's down 2%. Roku's up slightly. Twilio got destroyed this year. So, I mean, going into it, Twilio's already beaten up, but they're up 3%. Mercado up 8%. Coinbase up 1.3%. I'm really curious about Coinbase, but Amazon's taking the attention. And then we'll get to Coinbase. Amazon recovering. You're getting a green candle. It was down 6. Now it's down 2. Apple's at 430. Okay, so we have some time for Apple. There's a little bit of a fight in Amazon. There's a little bit of a fight. They're not going out without a fight. Let me pull up Coinbase. I really want to see Coinbase's numbers. I am so curious what the institutional and retail trading was for volumes for crypto, because that's going to give a signal not only for Robinhood, but that's going to give us a signal around if retail is back into Bitcoin yet. Of course, Coinbase is not going to update their website. Why don't they just like put it on the blockchain or some shit, dude? They never fucking update. Amazon at 184. So Amazon's recovering. It's down 1.8 now. It's down 1.8. It's not getting hit that bad. Coinbase, I don't think is out. Yeah, Coinbase is not. Coinbase might be 410. It's not out at all. Okay, I take back my anger around Coinbase. Overreaction, because the only thing that matters is AWS revenue, and they beat, unlike Microsoft. AWS taking more market share. So I don't think AWS is the only thing that matters. It is like a big thing that matters. What only matters to me, which I don't have the number for yet, I'm trying to pull it up on their website, is operating income, like the margins on the operating income, because that was the highest it's ever been since 2021 last quarter. If that's up, then this is absolutely an overreaction, because who cares if you missed $1 billion on revenue? Like if you're making more money on the actual product you're selling, then that's the reason the Street should expand your multiple. AWS we knew was going to do well, but now it's a question of operating income. If anyone has that margin, let me know. I don't see it on their website. Oh, I think I got it. Operating margin. Do I have it? No, I don't have the... No, I do. Operating margin. Okay, operating margin. If I'm looking at the right thing, Q2 2024. Oh my God, it declined. Fuck. It declined. Yep, there you go. It went down. Let me show you. It went down to 9.9. This is... There you go. If you're an Amazon shareholder, you've got to be annoyed at this. You have to be annoyed at this. It went from 10.7 to 9.9. Now, you might think 0.8% down is not a big deal. It's a big deal, dude. How many years are they going to spend with losing money on all these freaking water bottles and Chinese shit they sell on the website? Like, at some point, they need to make money on this. Yeah, Matt is a big Amazon shareholder in the chat. Matt is pissed. I agree with you, Matt. You should be pissed. At some point, Amazon needs to make some damn money on this stuff, dude. Like, that is not what you wanted to see. The stock's recovering a little bit, but the reason it's not breaking 200 is because the operating margins are down. They're not being cost efficient there. Or they're giving too many damn discounts on Prime Day or whatever, like whatever they're doing. They are not getting that margin to go higher. I mean, you can't go from the highest you've ever been since 2021 and then decrease the next quarter. Like, you're not going to get rewarded for it. I mean, you could do that, but the Street's not going to reward you. Not on that one. Not on that one. Roku is up 3% after hours. Mercado Libre is up 10%. Intel still down 12%. I'll get Intel's numbers in a second. Coinbase is down 2%. Amazon, now it's down 3%. So Amazon's still taking a hit. Prime Day was not on last quarter. I know, but you get my point, right? Like, my point is they're selling things at such a discount that they're not really able to get the margin. Yeah, I agree. Prime Day was not. My point is metaphorically, like, they're selling things. Prime Day is an example of the massive discounts they have to get people to buy stuff, which is great. You make it really sticky. No one's going to leave. But if they're paying $3 for something that's costing them $3.40, like those 40 cents that they lose, it's not going to help the earnings at the end of the day. And this is what we really want to see. Let me get to Intel. Get a little bit of coverage on Intel real quick as I'm pulling up Coinbase, and then we'll go there.
I mean, Foundry is the least of the issues right now. You expect that takes a while to spin up, but there were real hopes for the second half. Maybe client PCs hold out, but we've heard from the hyperscalers that they're spending on infrastructure, but clearly they're not spending on Intel.
No. Intel has been losing market share for years. I mean, I almost want to say, come back to me in 2027. Because there's going to be so much change at this company. I'm encouraged, sorry to hear that they're laying off people, but I am encouraged, at least on the cost side of things, that they're trying to get their ship or their house in order. But the market share is really disappointing. I had expected enterprise to be weak, but I expected PCs actually to be a little bit stronger because we have been getting little green shoots, right? From some like Seagate, for example.
Let me read some stuff off Intel, then we'll get back to that. Second quarter revenue was $12.8 billion, down 1% year over year. That's not surprising. Snapchat's getting destroyed. Where's Snapchat right now? Oh, they have earnings today? I forgot Snapchat. Oh my God, Snapchat's down 20%. Oh my God, Snapchat's... Hold on, we'll get back to Intel in a second. Hold on. I forgot about Snapchat. Oh my God, how many times is this going to happen for Snapchat? I have no position in Snapchat, but every time, dude, you think they figure some shit out. Boom. They just fall to the wayside every time, dude. This stock has been stuck at like $9, and then people buy it because, like, oh, at $9 it's cheap. It runs up to 15, and then it just crashes back down again. What the hell did Snapchat say? Apple's not out yet. Apple, we got 18 minutes. Snapchat revenue, $1.23 billion versus $1.25. Missed on revenue. EPS -15 versus -0.16. Still losing profits, but barely beat on EPS. There you go. MicroStrategy, by the way, revenue 111 versus 121. So they missed on revenue by 10 million. EPS, they lost $5.74 a share versus $1.11. They missed badly on EPS. However, they're not down that much because of some reason. I don't know the reason for that, but they're not down that much. Maybe it's because the market only cares about Bitcoin with them, but not sure. Amazon down 3.4, Intel down 11, Snapchat down 22% right now. Are there any beats? The only beat is Roku, I think. Let me pull up Roku real quick. Yeah, Roku's up a bit. Oh my God. Here's why Intel's really down, guys. They suspended their dividend. They suspended the dividend on Intel. Coin is not out yet. Or maybe Coin's coming out in like 2 seconds. Let me pull up Coin. But Intel, so real quick on Intel, EPS of 2 cents versus 10 cents. So they missed on EPS. Revenue 12.8 versus 12.9. They missed on revenue. They're suspending the dividend in Q4. So you've got 1 quarter left of collecting a dividend. I mean, the only reason people were really owning Intel was for the freaking dividend, right? Like, I think there's a 3.4% dividend there. And they're initiating a $10 billion cost-cutting plan, which is good. That's why you have the layoffs, but still not the best. Okay, Coinbase. We have DoorDash today. Let me add DoorDash. DoorDash is up 15%. Okay, we'll get DoorDash in a second, but DoorDash numbers are good. Coinbase up 1%. Let me pull up Coinbase. Yeah, we have Square. We'll look at Square in a second as well. Let's do Coin. Coinbase revenue is $1.45 billion versus, I think that comes in line with expectations. Trading volumes, 226 billion versus 219. So 7 billion of a beat on trading volumes. Here we go. I got the graphic. Here we go. 1.4 billion in revenue, 599 million in subscription, 36 million net income. number one in L2 transactions. Okay, this is okay. So basic stuff, nothing too crazy. I got to get to some deeper numbers on this. But it seems like Coinbase beat on the top and the bottom. And the trading volumes were good. It's not amazing, but it's good. Coinbase up. I don't think Coinbase is going to move super up because Bitcoin's not up. But outside of that, Coinbase seems to be hitting their numbers. Cloudflare is up 2.3%. DoorDash really hitting out of the park, up 15%. Snapchat's now down 22%. Coinbase now struggling to stay green. Let me see what else I can get on Coinbase. Coinbase revenue is up 108% year over year. Now that is a little, I mean, look, we were in like a crypto winter last time this year, so it doesn't matter too much, but their growth is good. Transaction revenue was 780 million versus 745. So they made about 40 million more on transaction revenues, which is bullish. That's good. But overall, not enough to make some massive beat. Okay, let's go to Square. Square's down 3%. Square is down 3%. Let me pull up Square's numbers as well. Let me see what else we have there. Okay, let's do DoorDash real quick. I think we have DoorDash. And then we'll do Square. Apple in about 15 minutes. Here's DoorDash.
About 14.5%, 15% here in overtime. DoorDash reporting a Q2 beat on the top line and a beat on the profitability metrics that the company guides to. This is important. I spoke to the CFO earlier this afternoon. The company doesn't guide to earnings per share, so that number is going to look like it missed consensus because a couple of one-time items. The guide here is a beat as well. So DoorDash reporting Q2 revenue of $2.63 billion versus $2.54 expected. Loss per share is 58 cents, while analysts were expecting a 9-cent loss. But again, that's GAAP and due to one-time items, including a write-down on office space and a set-aside for legal costs. Now, from operations, contribution profit came in above expectations at $825 million versus $782 expected. Adjusted EBITDA also came in way above expectations at $430 million versus $392 expected. Now,
okay, so DoorDash beat on the top and the bottom line. That's good. DraftKings is now tanking. Amazon is still tanking. I mean, it's not tanking, but down 4% is tough on a $2 trillion company. DraftKings has tanked, down 10%. Oh my God. All right. So real quick, let me do Square. So Square gross profit of $2.23 billion. That's up 20%. Net income $195 million. That's up year over year. GAAP EPS 31 cents. That's up more than 100% year over year. CEO Jack Dorsey says we're currently on track to reach Rule of 40 by 2026. That's not good to know that it's going to take them 2 years to get to that level, with adjusted operating income margins expanding significantly year over year for both Square and Cash App. And it looks like they beat on revenue. Square GPV $58 billion. That's up 8% year over year. Cash App monthly transacting activities is only up 5% year over year. And monthly active users on the Cash App card is only up 13% year over year. Not horrible, but not amazing. They repurchased $400 million in stock in Q2, and they're raising the full year gross profit outlook to $8.89 billion. Not a horrible earnings, but it's not enough to get the street excited. Square just went from red to green, so at least it's a little green, up 1.19%. So Square, you got a little bit of green there right now. Mercado Libre is up 8%. Square's been beat up a lot this year. So Square getting some momentum after these numbers, but initially it was down 5%. DoorDash up 13%. That's something the street really wanted. Snapchat still down 20%. And Cloudflare is up 9%. Okay, so SaaS is getting some momentum. Apple's out at 4:30, not yet. Marathon has earnings today. Let me put that on the list. Amazon still down. Marathon's up 1.54. Coinbase, remember, 10%, I think, of their gross profits goes into DCAing on Bitcoin on the balance sheet. Which is okay, but not the best. Oh, they missed on revenue. Never mind. Square missed on revenue. 6.16 billion versus 6.28. They beat on EPS, but they missed on revenue. That's probably why it was down 5% initially, but now it's recovering a little bit. Revenue is up 11% year over year at 6.16 billion, but it is down from the expectation. Square up 2.69% right now. Roku up 5.73. Intel down 12%. Amazon down 4%. Let's pull up Cloudflare and let's see if I can get those numbers as well. Oh boy, so far these are not great earnings. These are not horrible, but these are not great earnings. Coinbase is up 3% right now. Cloudflare revenue $400 million versus $394. They beat on revenue by about $6 million. EPS, it looks like they beat on EPS. I'm pretty sure it looks like they beat on EPS. It's a little confusing looking at it. I think they beat on EPS. That's why it's up right now, 9%. Yeah, it looks like, if I'm not reading it wrong, Cloudflare beat on EPS, and they raised their full year 2024 EPS and revenue, which is good. That's not horrible. Bezos was selling for a reason. Yeah, you probably knew that fucking the operating margins would not increase on Amazon. Again, guys, 9.9% operating margins. That's the story. That's the only thing you need to know about Amazon, in my opinion. AWS doesn't matter. Retail sales doesn't matter. They can't make any money on the damn business outside of AWS. And the majority of revenue is not AWS. It's selling water bottles from China and delivering it in 2 days. For that to go down quarter over quarter, that is not possible for Amazon if they wanted some appreciation. That's just not it. You can't do that. You cannot do. And a lot of the Amazon people that I talked to, they said that number was going to go up. And so, unfortunately, everyone who thought it was going to go up, it did not go up. But if it did go up, I think this would be a different story. Right now, that's not what we're saying. Okay, let's pull up Coinbase. Let's get Coinbase numbers right here. And let's keep going. Yes, we saw Intel. Intel's down. Bad guidance and getting rid of their dividend. That's why Intel's down.
EPS, we're not going to compare this number, but it was 14 cents. That was on 36 million of net income. There's a footnote here that talks about an impairment charge, so a pre-tax crypto asset loss charge, mostly an unrealized loss, but it is on the balance sheet and it's being reflected in earnings. So the losses were about 250 million after taxes. So something to note as well. Subscription services revenue hit an all-time high, 600 million. Coinbase now has about 7.8 billion in cash and cash equivalents on the balance sheet. They do not give guidance when it comes to EPS and revenue, but you can see shares slightly higher here after hours. Morgan and John, back to you.
All right. Okay, thank you. Now, Roku and Block earnings both out. Julia Borston has numbers for both. Julia.
Let's start with Roku. Earnings and revenues beating estimates. The company reporting a loss, an adjusted loss of 24 cents per share. That's a smaller loss than the 43 cent per share. Estimated revenues of 968 million, ahead of the 938 million estimated, and average revenue per user ahead of expectations. And the company's adjusted EBITDA also above expectations. And another key number here for Roku's streaming households, 83.6 million. That's ahead of the 82.95 million estimate. That means more people are using Roku than anticipated. You see shares are now up about 5.5%. Shifting gears over to Block. Block's earnings of 93 cents per share, missing estimates of 84 cents per share, revenues of 6.16 billion, missing estimates of 6.28 billion. The company raising its outlook for full year gross profit, now forecasting 18% gross profit growth for the year, also raising its outlook for adjusted EBITDA, as well as raising its outlook for adjusted operating income. So just to reiterate there, an EPS beat, revenue miss, but raising those the outlook there really pretty much across the board for the third quarter. CEO Jack Dorsey flagging in his shareholder letter that Block's adjusted operating income margins expanded significantly year over year for both Square and the Cash App. And Block is also giving a new expanded role to Nick Molnar. He is the CEO and co-founder of Afterpay, which the company acquired back in 2022. They say he will lead a centralized sales function, which they expect to drive revenue and sales. Now we see shares of Block are up about 4%. Back over to you.
All right, Julia, thank you. Interesting. Now let's get another check on Amazon. Those shares are down about.
Okay, we'll get back to that Amazon thing in a second. Will Apple save the day? I don't know, but we got 7 minutes to see for Apple. What are you guys thinking in the chat? What are you thinking? Some of these earnings are okay. Cloudflare is up 8%. DoorDash is up 14%. I mean, DoorDash, real quick, some numbers on Dash. It seems like their overall, not just sales, but their orders are going up, which means people are ordering more, which I guess is good. Like, that's not bad. Shows a pseudo healthy consumer, or the only people that are ordering DoorDash are people that can afford to pay the ridiculous taxes on it and the spending fees, delivery fees, tips, whatever. And maybe that's a certain segment of the consumer. DraftKings EPS of 22 cents, profitable for the first quarter ever, I think. Beating expectations of negative 0.01, revenue in line of 1.1 billion. They're buying back $1 billion of stock. They announced an official $1 billion share buyback program. Why is the stock down 3%? Okay, so it recovered. It was down 10%. That makes sense. DraftKings had no reason being down 10% on that quarter, but something happened for them to be still down. something happened for them to still be down. DoorDash is a big partner of PayPal. Okay, so that's bullish for PayPal. That's important. But this is weird, dude. This is weird. You got DoorDash and Roku that are up, and Twilio. Now, granted, Roku was beat up coming into this, so maybe that's also why it's getting a little sympathy bounce. Coinbase, I mean, their earnings, I just care about the crypto transaction volumes. I don't really care about their earnings because if you haven't figured it out by now, Coinbase only goes up if Bitcoin goes up. There's like, it is objective. There is no, oh, well, their operating margin, like, no one cares. And Bitcoin's down today, so Coinbase is not going to moon off this. But if they have big transaction volumes, that shows you that, that crypto ecosystem is still healthy. If that falls down the drain, that means people just aren't trading crypto anymore. And maybe Coinbase is not going to be, a popular stock in season because crypto is just not that popular anymore. So Coinbase trading volumes are good, but the stock itself is not going to go up until crypto goes up. Amazon is still down. Oh my God, it's falling more, down 5.6%. I think it's the operating margins on Amazon. I think that's it. Intel down 14%. Goodness gracious. All right, let's get some more coverage on Amazon. And we got Apple in 5 minutes.
4% after reporting weaker than expected revenue for the second quarter. Joining us now is Scott Devitt from Wedbush. Scott, they did face $1 billion currency headwind on the top line here. I don't know how much of that was factored in from the beginning. And AWS, a little better than expected. So what do you think of this reaction? Good quarter, mediocre quarter?
Yeah, hi, John. I'd say mixed. So the headline revenue number isn't really where investors focus because so much of that, almost 110 billion of the 150 billion is just retail, and that's impacted by 1P and 3P mix that get booked differently. But where the focus tends to shift to quickly is operating income, where they did beat with a 9.9% margin versus consensus at 9.2. As you mentioned, AWS at 19%, that's the fastest growth rate for AWS going back to when the business started to slow a couple of years ago. But the nit is the advertising revenue. That came in at 19.5%. Consensus was 22. So Meta advertising grew faster, and that was a pretty good deceleration from the last quarter. So we'd like to learn more about that. I think to me, that's the one thing that stands out as the negative, but the AWS is quite good.
Now, Scott, if that's the thing, if advertising revenue is the thing, has that become so important that if you believed in Amazon's story a few hours ago that you question it now? Is this potentially a buying opportunity if the stock trades here tomorrow? Or no, this is an important growth area?
It's an important growth area. I think you want to know, have a better understanding of what caused the deceleration. This is a $60 billion kind of revenue line that investors anticipate is going to grow significantly over time. So you want to be certain that they can keep an elevated growth rate for a long period of time. And personally, when you look at the entire report, I think a pullback is a buying opportunity. I think the strength in AWS overwhelms the advertising. But if I'm being transparent about it, the advertising that's not a good number relative to expectations.
So it sounds like probably a lot of questions about that on the call. So you got shares down 4%. I mean, up than what, 20% year to date. Expectations were pretty high going into this report. Even if you look at the consensus numbers for revenue, for operating income, they were at the higher end of Amazon's own guidance, higher end of the range of Amazon's own guidance in terms of what Wall Street was expecting. So I guess just how high was the hurdle for the company to cross today to be able to see a positive reaction here in general?
Well, in hindsight, it was high, right? But AWS performed. So expectations for AWS were rising going into the print, and it exceeded expectations. The advertising number, if you go back to Alphabet, YouTube's dealing with something a little different in terms of video advertising inventory growth. But the core search business outperformed expectations by almost 200 basis points. And then Meta had a very strong quarter and a strong guide. So you would have expected going into this print on the ad line for Amazon, it would have been a good number, and it wasn't. So that's where the expectations miss, is really centered. Overall, operating profitability, very good. Revenue is what it is. I call that in line-ish because you just don't know that mix shift dynamic that's happening in retail, and you want to focus more on the operating profit line more than anything. So it's a healthy number, but not perfect.
Okay, very quickly here. How much is CapEx spending on AI going to matter? How much do you expect them to talk about it in this call?
Okay. Apple. We got a minute, folks. Oh, Apple. Where is Amazon right now? Amazon's down 5%. I think they have a chance to save it on the earnings on the call, but as of now, I do think that is an issue. In the context of these operating margins. Okay, here we go. Apple. I don't have the numbers yet. I am waiting for the numbers like all of you guys. Let me know in the chat if you own Apple as well. Let me know if you own it. Apple's green. I got green. A little bit of green. It's 4:30. Oh, we're green. We're up 1%. We're up 1.3. We're green. We're up 1.5, 1.6. Let's see. Come on, baby. Let's see. It looks like it's not going to hold up. It's fighting for its life. Apple 221. Apple's now still green. Now it's red. Now it's green. Now it's red. Now it's red. Now we're red. Now we're red. Now we're red. Now we're dying. Now we're dying. Down one. Nope. Now it's recovering. Now it's green. Now it's. This is just. Now it's green. Now it's green. Now we're up. Yo, it does not know what to do with these numbers, bro. Third quarter revenue. Thank you for this in the chat. 85.7 billion versus 84. That's a beat. iPhone revenue 39.3 versus 38. That's a beat. China revenue 14.7 versus 15. That's a miss. They missed on China. Apple's now flat. Apple's flat, guys. Apple's flat. All we have is flat. EPS of 140. That's great. Thank you again for this in the chat. So we beat on top line, beat on bottom line, missed on China. It's just flat. It's like not really. Honestly, I'd rather it be flat than not. Now it's slightly green. Now we're green. Apple's already up 31% from the lows. If it can just hold these levels, that would be exciting enough. Apple, now it's up 1%. Now it's moving. Trying to get to 2% here. 222. 2%. There you go. Apple's 2. Apple's green. Apple is green. It's a green apple. Is that called a Granny Smith? Is a green apple called a Granny Smith? Is it a Granny Smith right now? Flat means green today. Yes, exactly. Flat means green today. Apple up 2.4. All right. Amazon still falling, down 5. Intel down 15. Snapchat down 18. Apple is 2%. So really no move on Apple. Let me see if we get Apple's numbers. All right, we got Apple's numbers. Let's see them right here. Apple still green, up 2% right now. That's it on Apple.
$1.40. Street was looking for $1.35, and revenue is a nice beat here. $85.78 billion. Street was looking for $84.53 billion. That's up 5% year on year. So this is another quarter of growth for Apple here. iPhone revenue was also a beat at $39.3 billion. Street wanted $38.8. And then services revenue, just a slight beat here, $24.21 billion versus $24.01 billion. That's up 14%, by the way, year on year, just continuing that double-digit acceleration in services we've seen. And then Greater China, that's been a sore spot for several quarters in a row for Apple here. That's down 6.5% year on year to $14.73 billion. Those are the top numbers for you guys. I'll have more for you in a bit, but I'll let you take it from there. We see shares down 0.3%, 0.2%, it looks like.
Yeah, still a lot of overtime to go, though, of course, and especially, I think, on that China.
All right, so Apple's not really that interesting. It's we thought it'd be more exciting. It is barely up. Let me try to get the actual numbers right now on their website. Oh my God, this is, at least it's better than Amazon. I didn't even know Amazon's advertising data missed as well. That's actually really concerning. I heard him say it on the CNBC, but I have to go through it. But if he said advertising missed, think about Amazon. Why are people advertising? They're advertising so people can buy shit. If people aren't buying shit, they're going to stop advertising. That's bad for the consumer. It's not good. It's not good. Do I have the numbers here on Apple? All right, here we go. Here is Apple. I'm streaming Amazon at 5:30. 5:30 at Amazon. Apple. Let me check real quick when they talk. I think Apple talks Apple talks at 5. So we'll go to Apple at 5. We'll listen to them for 30 minutes and then we'll go to Amazon. Okay. So Apple at 5 and then we'll do Amazon at 5:30 and we'll leave in the middle for Amazon. Now we know why Bezos was selling. Correct. Douglas says Vision Pro is doing well. Really? Really? Okay. Let's see. Is that the case? So are you trolling me? Are you trolling me or not? So revenue. Products revenue 61 billion, services 24 billion, net sales 85.7. Cool. R&D cost them 8 billion, yada yada, that's fine. Operating income 25 billion, net income 21 billion. So they have a decent net income margin on that revenue, on the top line revenue. That's decent. EPS 140, that's good. America led the way, 37 billion. China again missed. The street wanted about 15. They put in 14.7. iPhone 39 billion, Mac 7 billion, iPad 7 billion, wearables 8 billion, services 24 billion. Yeah, the Vision Pro is definitely not. Yeah. Dude, if they don't even categorize Vision Pro as a category here, dude. I think being bearish Vision Pro, you will be vindicated if you were bearish Vision Pro like myself. Now, maybe Vision Pro 2 will get me, but I've been publicly bearish Vision Pro. The Vision Pro, I never got it. I never understood it. They're not even separating it as a category, dude. Like it just wasn't it. It just wasn't it. And $3,500, I don't blame. But honestly, even if they put it at $1,500, most people that bought it's just sitting on their desk. Like there's not a use case for that at scale. Cash at 25 billion. They're growing 3% year over year. So you're paying a 34 premium, 34 price to earnings for 3% growth on Apple. Apple stock is, wow. It's like 32 cents away from going red. So all the premium is gone. The 2% premium that we had. Again, Apple just being flat, I think is a win. Snapchat's still down 16%. Mercado Libre is down 11%. Coinbase basically flat. Square's up 3%. Intel getting worse. Intel's at $23.95. Intel is getting schmacked. That one's bad, dude. When's the last time you saw Intel go down 20%? I mean, Intel's supposed to be a stock that's just like, it just stays there and you just have it in the portfolio. It doesn't move too much. Mercado Libre is up 12%. Amazon still down 4.8%. Apple barely green. Bitcoin's pumping, really? Maybe that's why Coinbase and MicroStrategy aren't getting hit that bad either. Bitcoin's pumping. Bitcoin. Where's Bitcoin? Bitcoin. Why? Hold on. Where's Bitcoin? 63.9. I don't know if that's pumping. I mean, yeah, it's back to 64. So I thought you meant it's a little bit more than that. Robinhood after hours is at 2012. Coinbase up 1.52. CleanSpark is at 1.32 on the day. Yeah, Amazon sucked. Apple not the best, but Apple at least is fine. Yada yada yada. The 10 that's a 10-year low for Intel. Wow, dude. Holy crap. I mean, Intel, honestly, I got to go through the numbers, but buying the dip on Intel, maybe that's the wave. We got to see what the numbers are. But Intel, if you look at the 5-year, yeah, it's definitely a 5. Last time they were at 23.54 was 2022. So they're back at 2022 levels. There is a lot of support at 23. If it breaks below 23, it's going to crash. It's already crashed, but breaking below 23 would be catastrophic. DraftKings is up. Okay, good. DraftKings deserves to be up. Yeah, they're profitable for the first time ever. I thought they would be profitable. $1 billion in share buybacks, revenue in with expectations. DraftKings deserves to be up. That's okay. That's good. Nvidia, yeah, where is the semis after hours? Let's look at the semis. I don't think they're going to react too much to Intel, but Nvidia's up a little bit. AMD's down a little bit. SMCI 669. Where's the S&P? S&P is at 541. They're down. The NASDAQ is down another 0.5. Oh boy, that means the NASDAQ's down 3% for the day. If you include after hours, the NASDAQ has had a similar day that it had last week on Wednesday, down 3%. It's probably in line with one of the worst days since 2022, if you include the after-hour trading on the NASDAQ. S&P is down 0.3. And then look at the SMH index. That's down another 1% after being down 6.4% on the day. So that one's down a cool 7.5% in the semiconductor space. That is red. That's red. Amid Amazon beating operating margins expectations, to be fair, 9.9 versus 9.2. Yes, but I still think if they had put up higher than 10.7, the narrative would have changed. And look, this is not me saying that. I've talked to Amazon bulls and they said, hey, this is the quarter where you've been waiting a couple of years because they made the inflection point last quarter by getting to the highest level they had in 3 years. Now they just have to follow up. Them missing on that number, but beating quote unquote expectations, I think that's what got them hit. I think they could have hit on a lot of different numbers like AWS, but how many times are you going to lose money every quarter on all this other shit you're paying for before the street gets upset? Look, I'm still long Amazon long. I love Amazon. I think it's one of the big tech stocks you have to be long over the next decade. However, in terms of the short-term price movement, yeah, the street's not going to be look, Amazon's almost down 7%, dude. 6.4. That and advertising. Let me put up Amazon's numbers. We didn't go through their deck yet. Advertising seems to be another issue with Amazon. Okay, net sales increased 10%, 148 billion. AWS 19% year over year. Operating income 14.7 billion. Where's advertising? Advertising, they put up 12.7 billion this quarter. That's up 20% year over year. I guess the street wanted more. That's healthy growth, in my opinion, up 20%. I guess the street wanted more. AWS 19%, subscription services up 11%, third-party seller up 13%, physical store sales up 4%. That's Whole Foods. And then online stores. Look, they make, dude, out of the 148 billion in revenue, look at that number. They make 55 billion off Amazon.com, and they make 9.9% on that 55 billion. That's just not enough for the street to feel that it deserves the continued multiple. Amazon is a bit more expensive than some of these other stocks out there, but you justify it because it's Amazon. You can't justify it if those margins are down. Again, long-term shouldn't be an issue. Long-term, I think 300 is coming around the corner, hopefully in the next couple of years. Like, I think Amazon's, the growth story is there. It is just in the short term, that's the pain that we're seeing right now. Another name, thank you for the super chat. 200-day simple moving average for Intel is bad. Technicals look terrible, and I'm doubtful about their fundamental long-term. My 2 cents. Yeah, look, you have no. I have no problem with that bear case. I'll give you that. I mean, really, for Intel, it's a wait and see. I don't think anyone needs to buy the dip until you see if it can hold 23. If you got to pay 26 or 27, that's way better than having to pay 19 or 18. So Intel right now it's at 24.05. It's got to hold 23 for a couple weeks before I think people get really excited about it. But if it stays at that 26, 27 level, maybe there's some momentum there. Now, again, 2027 is when they expect Foundry to be profitable. If you expect any weakness in TSM, that's your tailwind. But if you don't expect weakness in TSM, I would rather, buy more TSM, even if it's pricey, than Intel, because Intel obviously haven't proved they can profitably make chips yet in the Foundry business. Amazon down 6.4%, S&P down 0.42%. What a start to August already. Yeah, what a start to August already. Where's Apple? Is Apple red now? Apple is still green. It's flat, but it's green. It's flat, but it's green. Wait, could you sum up why Amazon Q2 is bad? I'm reading it and it's fine. Amazon's Q2 is not bad. Let me be very clear. Their operating margins are bad, even though they beat on the expectations. Revenue, they did miss by $1 billion. That technically is bad. And then advertising, apparently, advertising was a miss in terms of expectations, even though it's up 20% year over year. So that's kind of the issue you're seeing with Amazon. But I don't think the quarter was bad. AWS was exceptional. I thought AWS was great. 19% year over year. The problem is, I believe the street wanted more on some other segments, which is why things are bad. MicroStrategy brought another 11 million of Bitcoin. Okay, MicroStrategy has bought a lot of Bitcoin at this point. 11 million is just a little couple pennies for them, but they bought some more Bitcoin. Crossroads says this looks exactly like my prediction for Amazon. Good numbers, but the market was looking for an excuse to sell, and they found it in advertising. Yeah, that could be an argument as well. Let's get some more coverage on Apple, and then we'll keep going. But I do think the Amazon miss, which seems like it's a slight miss. I didn't even know that advertising was that bad. That's what's justifying a little bit more of the sell-off.
Declines related to China. I think that's something that people are going to be watching closely as well.
Okay. Well, we're going to get back to Steve Kovac with shares of Apple turning positive. He's got more on these results. Steve.
Hey, Morgan. Yeah, I caught up with Apple CEO Tim Cook on these results a little bit. And of course, much of our conversation did center around artificial intelligence and where Apple plays into that. Let me give you a few things. I talked to him about capital expenditures related to AI. That has been such a huge thing that we've seen from his other peers in big tech. Here's what he told me about AI spending and CapEx. First on AI spending, quote, what we've done is redeployed a lot of people onto AI that were working on other things. So that basically saying managing costs, they're not spending as much, but also taking their talent, moving them over. A lot of the Apple Car project people, after that project was canceled, move over to AI, for example. And then on capital expenditures, he told me, quote, this quarter is an increase year over year in their amount we're spending for AI and Apple Intelligence. So also increasing their CapEx as they have to build out these AI capabilities, both on, on the server side and things, and also the personnel side, things like that. And then I asked him specifically about the rollout of these artificial intelligence features. We know, for example, that they're going to start here in the United States in English only. But then the question becomes, when do we start seeing that roll out globally, particularly in China, which has some really tough AI regulations that need government approval before you can launch there? Here's what he told me about that, quote, we're working on exactly what we will do there, meaning China, and there are definitely regulatory questions there that we have to respond to, and we're working constructively on those. And by the way, I also just asked him in general, does he see Apple Intelligence features kind of driving demand for iPhone sales? Has he seen any signals so far about that? Not yet. Basically, he told me we have to wait until this launches, and that's typically when you see people start to show their interest and the demand starts to show. So it's going to be until probably the end of next month that we start to see that going one way or the other, guys.
Okay.
Okay, Marathon is out. This is a Bitcoin miner. They are down 6%. Revenue's up 78% to 145 million. They lost 148 million. No, they lost 199 million. Adjusted EBITDA decreased to a loss of 85 million. The stock is down, so something in their guidance, I'm assuming, even if they beat on the top and the bottom, or they missed on the bottom, they beat on the top. Marathon's down 5.4%. Marathon was down 7.78% today as well. So Marathon, you got a 12%. Now, Marathon's used to 12% up or down pretty much every other week, given Bitcoin's volatility, but not the best for Marathon. Is CleanSpark affected because of that? CleanSpark's still up 1% after hours. NASDAQ down 0.53%. SMH down 1%, S&P down 0.34%. Apple still green. Market really is not selling off Apple on this. They're okay with these numbers. Amazon is recovering slightly, down 4.6%, up from 6%. CrowdStrike, I agree. It looks like that thing is headed to disaster. And I think there will be a generational long opportunity on CrowdStrike based on the Q2 guidance. I think under 200 is very possible now. Especially given they're going to have to give a lot of rebates to these customers. But that'll be a story you really want to go long on if you believe in cybersecurity and if you believe the company can save the execution for the future over the next 5 years. I mean, if CrowdStrike goes to like 190, 170, 150, whatever, I don't think it's going to recover for a while. So that's just one of those things where you're going to get to build a position, and hopefully their stellar free cash flow and average recurring revenue growth continues to occur. If not, it might be a value trap. We're going to have to see. Zocol says, I'm at work listening with my earpiece till one of these patients call. Shout out to you, Zocol. Thank you for doing what you do. Let me know in the chat, where are you as you're discovering that the stock market is collapsing in 2024? Where are you right now? I'm just being dramatic, but put in the chat, where are you? Are you at work? Are you in college? Are you eating a cup of ramen noodles that you know you're going to have to eat for a long time? What are you doing? What are you doing right now? AMD, Kathy bought AMD yesterday. And of course, fucking AMD down 8% today. Goodness gracious, dude. She bought like 400,000 shares or something. Carnival Cruise is up a little bit after hours. IWM as well took a nasty beating, down 3.25% of the day. We got Apple talking in 12 minutes, guys. And then we'll go to Amazon at 5:30. Apple will be live in 12 minutes. Someone said they're taking a dump. Okay, that's phenomenal. Someone said they're on the toilet. Do all of you just listen to me on the toilet? Is that when you have time for me? Look, another person said on the toilet. Do people just listen to me? Am I only valuable when you're on the toilet? Really? Is that the case? Is that how special I am to you guys? At home working, cooking ramen. Adam, you own a ramen restaurant, right? That's why that's funny. That's funny. I like that one. On the couch, working, in my shed in the rain. Okay, that's interesting. In the rain. It's sunny in it was really hot in New Jersey today. It was very hot. It's the only time we can be at peace. That's got it. Toilet time is an honor. No, well, that's true, dude. Toilet time is an honor. That's fair. Everyone's puking from today. Oh my god, dude. Booking earnings, yeah, BKNG, they had earnings as well, right? Booking Holdings, they're down 3.78%. This stock is $3,000? No way. Like, has no one introduced them to what a split is? BKNG? Dude, what the fuck? BKNG's 3,005. Who the hell is buying BKN? I'm not saying it's expensive because obviously it's based on the market cap, but like, why is the stock $3,600? Like, do a fucking split, dude. What is going on? Bitcoin's going up right now. Are people leaving the stock market for Bitcoin? Because that would be pretty cool if people are fleeing the stock market for Bitcoin. Let me get BKNG up in a second. Also, ARM is down right now. ARM is down another 1% after hours. ARM down 16%. Booking beat revenue by 7%. 5.8 billion versus 5.75. EPS of $44 a share versus 34.9. They beat by 27%. Versus 37.8. So they beat by 27%. So that's why booking's still down right now. Something in guidance must have been there. It's down 4%, but they beat on the top and the bottom line. They beat on the top and the bottom line. Joseph Carlson bought it at $4,000. So I've heard of Booking. It's a $124 billion market cap. I've heard of this company. It's a travel company. Yeah, it's a travel company. I don't know a lot about them. I've got to go deeper into them, but I'm assuming their guidance wasn't the best, which is why they're getting a little bit of a hit. I think I have some coverage on Booking. Let me pull them up, see if I can get that. Yeah, here we go. We also have some coverage on Snapchat in a second, so let's pull that up. Okay, here we go.
Has those numbers, Kate?
Hey there, John. This is a beat on the top and bottom lines for Booking Holdings. EPS, $41.90 adjusted, better than the $38.37 analysts were looking for. Revenues also beat for Q2, $5.86 billion versus the $5.77 billion that analysts were looking for here. And the company's CEO, Glenn Fogel, saying our business continued to perform well with room nights, revenue, and operating income exceeding our prior expectations. Room nights also booked increased 7% from the prior year quarter. The stock is unchanged, but it seems the experienced spending in this economy continues. Back over to you.
All right, Victoria, your take on this? I mean, travel have been strong. People want to go out and have experiences, and Booking seems to be reflecting that.
Yeah, and I think it's great that, again, they're continuing to hold off other competitors, either at Airbnb or VBRO or direct booking with Hilton and Marriott. They're putting themselves well established. They have good partnerships. And for me, it is. I think travel and food, quite frankly, well, being picky about our food, but travel and food has been two areas that we continue to spend on and we are prioritizing spending on. And people continue to see the value from Booking, whether it's the easy interface, whether it's the lower prices, and they continue. Obviously, you have more rooms booked. You know, you beat on almost all three of the most major matrices we would look at that company. So you got to like what they have to say. I'm a little, interested on what the guidance is. How much of this was just a really hot summer travel season? Are they getting a pickup from the Paris Olympics? Are they getting hit a little bit with the war in the...
Let me see if we have Snapchat coverage here as well. Here's Snapchat.
With a $1.6 billion analyst consensus, but we see shares trading lower, and here is what is weighing on the stock. The company guided to adjusted earnings of 70 million to 100 million for the third quarter. That's lower than the 110 million street account estimate. So it really seems like that's what's pushing shares lower. Global daily active users were a million more than anticipated, 432 million. And the company announced monthly active users, 850 million. That's a big jump from the 800 million most recently announced back in February. But we see, guys, shares down at 23% now in after hours trading. The company is saying that brand ad revenue declined 1%, but the direct response business grew 16%. So,
okay, so we've had an hour to kind of look at these earnings. In 6 minutes, I'll head over to Apple's earnings call. Marathon's up a little bit. Marathon recovering some of their gains or their losses. Cloudflare's up, which is good for SaaS. DoorDash is up, which is, I guess, good for people ordering food. Maybe you could extrapolate the consumer there. Snapchat down 17%. This is because Snapchat is a horrible business. MicroStrategy down 1%. DraftKings down a little bit, but they're profitable. That's great. Mercado Libre, haven't looked at their numbers. I'm assuming they're pretty fantastic to be up 10%. This is basically the Amazon of Latin America. So that's doing good. Twilio is up 6%. Twilio was beat up going into the year. They fired their founder, CEO. The board ousted him. So internal politics there. Twilio is whenever you get a text message from a company that says to enter this code into like a confirmation, Twilio is sending you that SMS. Roku 6.65%. Square up 4%. Coinbase down up 2%. Intel down 20% at this point. Coinbase or Intel is 40 cents away from going below 23, which is major support. Apple up almost 1%. And then Amazon's down 4.6. Given the pain we saw this morning in the broader market and in the macro, and given the pain we're seeing right now in the stocks that are reporting, particularly on Amazon, which again, I don't think is that big of a deal, but there are certain things that are messing with it. I think it's still too soon to say recession. I think we need a little bit more data. I think the Fed cut can help, but I think tomorrow is going to be a little tough. Either tomorrow we rebound from this and the market says it's stupid for Amazon to be at 170, or the market feels, no. People are going to stop buying stuff on Amazon. Cloud's going to slow down because if the consumer generally stops consuming, businesses have to slow down, which means they pay less to the cloud, to GCP, to Azure, all that stuff. If people aren't using ChatGPT that much for whatever reason, then Azure's AI cloud's not making that much revenue. Like in general, recession hurts everybody. You can make the argument that more people come to Amazon for cheaper stuff if a recession happens, but the stock is still going to suffer. If that is the perception and the narrative over the next couple of days or weeks, throughout August, let's just say, then we got some more pain coming for the markets. I still think that perception is a bit premature, and that pain, although it's real, August tends to be choppy in general. I don't think that's sell everything, raise cash, and get afraid of this market. But I don't know if that necessarily means go crazy and buy the dip yet. Just entered Palantir calls for December. You still have hope in them. I never do options. I never buy options on Palantir. I just don't think I understand Palantir enough to understand price direction. I think I understand the business. Price direction is different, and that's primarily because Palantir gets a multiple for a variety of reasons that can be taken away or that can be added to. So I never buy calls on Palantir. If the strike is close to 25-30, I think there's obviously a chance it does well in December. If the strike is 35, 40-ish, I think that's a little bit tough. I think 30 is pushing it, but you never know. Q2 earnings might be exceptional. It really depends. Dude, if NVIDIA is closer to 130 at the end of the year, Palantir is probably closer to 32, 34. As long as their growth keeps up with it. But if NVIDIA is stuck at 100, I don't know if Palantir can get to those elevated levels. Like the broader market is just not going to give it a multiple. As you guys have seen over the past couple of days, everything like Robinhood. Robinhood is deeply undervalued at $19.83. Even Robinhood today got sold off to $19.83. Why? Because nothing's safe when the stock market's selling off. Algorithms are taking place. Stop losses are getting triggered. Hedge funds are obviously hedging, and things get sold. So even if Palantir has an exceptional earnings, if everything's getting sold off, I don't know if they're able to maintain their multiple. Snapchat still down 17%. Bitcoin 64,652. Bitcoin's up right now. Amazon down 4.3. CrowdStrike down another 1%. The NASDAQ recovering a little bit. It was down 0.5. Now it's down 0.3. We'll see what Amazon and Apple say. Maybe that changes a little bit of the after hours price action. NVIDIA is up a little bit after hours. NVIDIA's up now, 110. See, another reason I'm not like, oh my God, scared, get out of the whole market, et cetera, is because a lot of this is short-term pain and like volatility that's expected on a market that's up. At one point, it was up like more than 20% year to date, right? Coinbase up 5%. Nice. So, well, it's up 5% because Bitcoin's going up, right? If the market is if the market is up this much in August, like it's not just going to go up 40%, right? This is not like the Industrial Revolution or something, even though I know people are comparing that with AI, but like if it's up a lot, it's going to have swings, and those swings are going to test your patience. If you're ultimately long, I don't think that means we're getting a 2022 NASDAQ goes from 16,000 to 10,000. Maybe that does happen. Who knows? Maybe I'm wrong. But I think there's too much baked in to see that kind of play out. And I think days like this shake out a lot of people. I don't know if it's the if it's the reason, if it's the reason for why you should get out of the entire market. I think it's a bit premature. Trimming, sure, that's totally fine. Trimming is not horrible at all, but I don't know if it's the reason you get out of this market. Apple earnings. I'm trying to pull up their webcast. There it is. Okay, I have it. So ultimately what I'm saying is, like, if the market, if your fundamental thesis is intact, the short-term volatility of it is definitely going to get scared of, retail's going to get scared of it because they have, they have paper profits. Those paper profits go down. They want to keep some of their profits, so they're going to get out, keep some of their profits. I think that's when institutions tend to jump in a little bit and bottom feed and get excited. We would have to see such a string of bad economic data from a labor perspective, from a consumer perspective, and then from an earnings perspective, and earnings really from the Mag 7, that lets you know things are really coming down. And from a GDP perspective, for me to think, okay, recession is absolutely on the way. Maybe that's too late. Maybe that's right when you should trim. But I think I think getting out of the market is still premature. At least that's not what I'm doing right now. But I also don't think you have to buy the dip heavily because I think we're going to have some time and some more volatility to see how this plays out. Apple should be starting soon. I think he is saying to sell everything and buy Pokemon cards. Correct. That's what we got to do. Open had earnings. I forgot about Open Door. Real quick, Open Door. A lot of earnings today, guys. Open Door is down 8%. That was expected. Open Door is one of the crappiest SPACs I've ever seen in my life. So if you got Open Door, I'm sorry about that. But again, yeah, I don't want to fear monger. I think long-term theses are intact. I think J-Powell has a big tool up his sleeve with the rate cut. Maybe more than 25 basis points. And I think that's going to provide momentum to the broader markets. Along with the fact that I think NVIDIA is going to crush as well, because all the big tech companies are spending a lot on CapEx. And that CapEx is going to be monetized eventually.
Good afternoon, and welcome to the Apple Q3 Fiscal Year 2024 Earnings Conference Call. My name is Suhasini Chandramouli, Director of Investor Relations. Today's call is being recorded. Speaking first today is Apple CEO Tim Cook, and he'll be followed by CFO Luca Maestri. After that, we'll open the call to questions from analysts. Please note that some of the information you'll hear during our discussion today will consist of forward-looking statements, including, without limitation, those regarding revenue, gross margin, operating expenses, other income and expense, taxes, capital allocation, and future business outlook, including the potential impact of macroeconomic conditions on the company's business and results of operations. These statements involve risks and uncertainties that may cause actual results or trends to differ materially from our forecast. For more information, please refer to the risk factors discussed in Apple's most recently filed annual report on Form 10-K and the Form 8-K filed with the SEC today, along with the associated press release. Apple assumes no obligation to update any forward-looking statements, which speak only as of the date they are made. I'd now like to turn the call over to Tim for introductory remarks.
Thank you, Suhasini. Good afternoon, everyone, and thanks for joining the call. Today, Apple is reporting a new June quarter revenue record of $85.8 billion, up 5% from a year ago and better than we had expected. EPS grew double digits to $1.40 and achieved a record for the June quarter. We also set quarterly revenue records in more than 24 countries and regions, including Canada, Mexico, France, Germany, the UK, India, Indonesia, the Philippines, and Thailand. And we set an all-time revenue record in services, which grew 14%. At our Worldwide Developers Conference, we were thrilled to unveil game-changing updates across our platforms, including Apple Intelligence. Apple Intelligence builds on years of innovation and investment in AI and machine learning. It will transform how users interact with technology, from writing tools to help you express yourself, to Image Playground, which gives you the ability to create fun images and communicate in new ways, to powerful tools for summarizing and prioritizing notifications. Siri also becomes more natural, more useful, and more personal than ever. Apple Intelligence is built on a foundation of privacy, both through on-device processing that does not collect users' data and through private cloud compute, a groundbreaking new approach to using the cloud while protecting users' information, powered by Apple Silicon. We are also integrating ChatGPT into experiences within iPhone, Mac, and iPad, enabling users to draw on a broad base of world knowledge. We are very excited about Apple Intelligence, and we remain incredibly optimistic about the extraordinary possibilities of AI and its ability to enrich customers' lives. We will continue to make significant investments in this technology and dedicate ourselves to the innovation that will unlock its full potential. Recently, we've also been excited to bring Apple Vision Pro to more countries, giving customers the chance to discover the remarkable capabilities of this magical device. Vision Pro users are customizing their own workspaces, watching movies on 100-foot screens, and exploring entire worlds with just a pinch of their fingertips. With more than 2,500 native spatial apps and 1.5 million compatible apps for Vision OS, the developer community continues to pioneer stunning spatial experiences that are only possible with Vision Pro. Last month, we announced that we're bringing some amazing new immersive content to Vision Pro, including new series, concerts, films, and more. And we've seen great interest for Vision Pro in the enterprise, where it can empower companies large and small to pursue their best ideas like never before. With each innovation, we're unlocking new ways of working, new ways of learning, and new ways of tapping into the unlimited promise of human potential. We're doing that across every product and every service. Now let me share more detail on our June quarter results, beginning with iPhone. iPhone revenue was $39.3 billion, down 1% year over year. On a constant currency basis, we grew compared to last year. Customers continue to praise the iPhone 15 lineup for its incredible battery life, exceptional cameras, and unmatched power and performance. And we are excited to bring incredible new features to the iPhone with iOS 18, making it more personal, capable, and intelligent than ever before. This update includes the biggest redesign of the Photos app, new customization options for the home screen, messages over satellite, and the introduction of Apple Intelligence. Apple Intelligence utilizes the power of our most advanced iPhones, the iPhone 15 Pro and Pro Max, offering a transformative set of capabilities. Mac revenue was $7 billion, up 2% from a year ago. Customers are loving the latest M3-powered 13 and 15-inch MacBook Air. With back-to-school season upon us, MacBook Air is the perfect companion for students on campus. And small business owners, developers, and creatives of all kinds depend on Mac to do more than they ever could before. Powered by Apple Silicon with its neural engine and privacy built in at the chip level, Macs are simply the best personal computers for AI. And every Mac we've shipped with Apple Silicon since 2020 is capable of taking advantage of Apple Intelligence with macOS Sequoia. We also know the importance of security for our users and enterprises, so we continue to advance protections across our products. Turning to iPad, revenue was $7.2 billion, 24% higher year over year. During the quarter, we had an incredible launch where we unveiled the all-new 11 and 13-inch iPad Air, the perfect device for education, entertainment, and so much more. And with the new iPad Pro, we pushed the boundaries of power-efficient performance with the remarkable M4 chip, the engine behind this incredibly thin device. By leveraging the latest in Apple Silicon, video editors and musicians can take advantage of the cutting-edge AI features in Final Cut Pro and Logic Pro. And we're very excited that iPad Pro and iPad Air models powered by the M series of Apple Silicon will be able to utilize the powerful capabilities of Apple Intelligence. In wearables, home, and accessories, Revenue was $8.1 billion, down 2% from a year ago. Apple Watch is empowering users to live a healthier day with a range of tools to take charge of their wellness journeys. At the core of Apple Watch are powerful AI features that are helping users get help when they need it most, from irregular heart rhythm notifications to walking steadiness to crash detection and fall detection. I've heard time and again how meaningful these features are for users and their loved ones, and their stories motivate us to keep pushing forward on this vital work. As I mentioned earlier, in services, we set an all-time revenue record of $24.2 billion, with paid subscriptions climbing to an all-time high. We achieved revenue records in the majority of the services categories, with all-time revenue records in advertising, cloud, and payment services. Apple TV Plus productions are delighting audiences on screens large and small. We're sharing powerful works of imagination with series and movies like Presumed Innocent, the upcoming Disclaimer, and The Instigator starring Matt Damon. And we can't wait for returning fan favorites with new seasons of The Morning Show, Slow Horses, and Severance. Apple TV Plus productions also continue to earn accolades with nearly 2,300 nominations and 500 wins to date. That includes 72 Emmy Award nominations across 16 programs, our best ever showing for the upcoming awards event. During the quarter, we also expanded Tap to Pay on iPhone to more markets, including Japan, Canada, Italy, and Germany, enabling more businesses to use the power of iPhone to accept contactless payments. And we announced new updates to our services coming this fall, including U.S. National Park hikes and custom walk routes in Apple Maps, the ability to pay with rewards using Apple Pay, collaborative listening with Apple Music, and a redesigned Apple Fitness Plus experience to help users make the most of our library of workouts and meditations. Turning to retail, we continue to expand in emerging markets with our first ever location in Malaysia. Customers from all over the country came together with our team members to celebrate this special moment. Elsewhere in the world, our teams have been sharing the magic of Apple Vision Pro in demos that delight, inspire, and deeply move customers exploring the wonders of spatial computing for the first time. At the heart of all of our innovations are the values that guide everything we do. We believe fundamentally that the best technology is technology that works for everyone. And in honor of Global Accessibility Awareness Day, we introduced all new capabilities to give users more ways to take advantage of all our products can do. These include eye tracking for users to control iPhone or iPad visually, music haptics to give those who are deaf or hard of hearing a tangible way to experience music, and vocal shortcuts that tie tasks to a user's voice. And we are committed as ever to shipping products that offer the highest standards of privacy for our users. With everything we do, whether it's offering a browser like Safari that prevents third parties from tracking you across the internet, or providing new features like the ability to lock and hide apps, we are determined to keep our users in control of their own data. And we are just as dedicated to ensuring the security of our users' data. That's why we work to minimize the amount of data we collect and work to maximize how much is processed directly on people's devices, a foundational principle that is at the core of all we build, including Apple Intelligence. And we continue to make significant progress on the environment. We are proud to say that all of our data centers, including those that will run private cloud compute, operate on 100% renewable energy. At Apple, we're constantly accelerating our pace of innovation. We are a company in relentless pursuit of big ideas. Time and again, we've seen how a spark of creativity can reach breakthrough velocity, reach across previously unexplored dimensions, and ultimately take flight in ways that can change the world. It's why we're going to keep investing in the meaningful innovation that enriches the lives of all of our customers. We have a busy time ahead of us, and I couldn't be more excited for all the amazing things yet to come. With that, I'll turn it over to Luca.
Thank you, Tim, and good afternoon, everyone. We're very pleased to report a new June quarter revenue record of $85.8 billion, up 5% year over year, despite 230 basis points of negative foreign exchange impact. We achieved growth in the vast majority of our markets, with June quarter revenue records in the Americas, Europe, and rest of Asia Pacific. Products revenue was $61.6 billion, up 2% year over year, driven by the launch of the new iPad Pro and iPad Air. Our installed base of active devices reached an all-time high across all products and geographic segments, thanks to our unmatched levels of customer satisfaction and loyalty, and a large number of customers who are new to our products. Services revenue reached an all-time record of $24.2 billion, up 14% year over year, with an all-time record in developed markets and a June quarter record in emerging markets. Company gross margin was 46.3%, near the high end of our guidance range, and down 30 basis points sequentially, driven by a different mix within products, which was partially offset by a favorable mix shift towards services and cost savings. Products gross margin was 35.3%, down 130 basis points sequentially, primarily driven by mix, partially offset by favorable costs. Services gross margin was 74%, down 60 basis points from last quarter. Operating expenses of $14.3 billion were at the low end of the guidance range we provided and up 7% year over year. Net income was $21.4 billion. Diluted EPS of $1.40 was up 11% year over year and set a June quarter record. And operating cash flow was very strong at $28.9 billion, also a June quarter record. Let me get into more detail for each of our revenue categories. iPhone revenue was $39.3 billion, down 1% year over year, but grew on a constant currency basis. We set June quarter records across several countries, including the UK, Spain, Poland, Mexico, Indonesia, and the Philippines. And the iPhone active installed base grew to a new all-time high in total and in every geographic segment. During the June quarter, many iPhone models were among the top-selling smartphones around the world. In fact, according to a survey from Kantar, iPhone was the top-selling model in the US, urban China, the UK, Germany, Australia, and Japan. Customer satisfaction on the iPhone 15 family continues to be extremely high, with 451 Research measuring it at 98% in the US in their latest reports. Mac generated $7 billion in revenue, up 2% year over year, driven by the MacBook Air powered by the M3 chip. We saw particularly strong performance in our emerging markets, with June quarter records for Mac in Latin America, India, and South Asia. The Mac installed base reached an all-time high, with half of MacBook Air customers in the quarter being new to Mac. And customer satisfaction for Mac was recently reported at 96% in the US. iPad revenue was $7.2 billion, up 24% year over year, driven by the launch of the new iPad Pro and iPad Air. Customers are loving the latest iPad lineup for its new design and display, unparalleled performance, AI capabilities, and much more. The iPad installed base has continued to grow and is an all-time high, as half of the customers who purchased iPads during the quarter were new to the product. Also, customer satisfaction was recently measured at 97% in the US. Wearables, home, and accessories revenue was $8.1 billion, down 2% year over year, a sequential acceleration from the March quarter. Watch and AirPods continue to face a difficult compare against prior year launches of the AirPods Pro second generation, the Watch SE, and the first Watch Ultra. Apple Watch continues to attract new customers, with almost 2/3 of customers purchasing an Apple Watch during the quarter being new to the product, sending the Apple Watch install base to a new all-time high. And the latest reports from 451 Research indicated customer satisfaction of 97% for Watch in the US. In services, total revenue reached an all-time record of $24.2 billion, growing 14% year over year. We continue to have great momentum in services as the growth of our installed base of active devices sets a strong foundation for the future expansion of our ecosystem. And we see increased customer engagement with our services offerings. Both transacting accounts and paid accounts reach a new all-time high, with paid accounts growing double digits year over year. Also, paid subscriptions showed strong double-digit growth. We have well over 1 billion paid subscriptions across the services on our platform, more than double the number that we had only 4 years ago. And we're constantly focused on improving the breadth and quality of our services, from critically acclaimed new content on Apple TV Plus to new games on Apple Arcade and the many latest features we previewed during WWDC for iCloud, Apple Pay, Apple Cash, Apple Music, and more. Turning to enterprise, we continue to see businesses leveraging our entire suite of products to drive productivity and create.
I'm sorry, this is super boring, guys. We got 10 minutes of it, then we're going to Amazon at 5:30. We're going to miss the Q&A, but unfortunately, Apple is boring for the first 30 minutes, I guess.
Beyond their existing iPhone and iPad deployments to provide their employees with the latest MacBook Air. And American Express has continued to add to their fleet of over 10,000 Macs to enhance their employees' productivity, security, and collaboration. We're also excited to see leading organizations such as Boston Children's Hospital and Lufthansa using Apple Vision Pro to build innovative spatial computing experiences to transform the training of their workforces. Let me now turn to our cash position and capital return program. We ended the quarter with $153 billion in cash and marketable securities. We repaid $4.3 billion in maturing debt and increased commercial paper by $1 billion, leaving us with total debt of $101 billion. As a result, net cash was $52 billion at the end of the quarter. During the quarter, we returned over $32 billion to shareholders, including $3.9 billion in dividends and equivalents and $26 billion through open market repurchases of 139 million Apple shares. As we move ahead into the September quarter, I'd like to review our outlook, which includes the types of forward-looking information that Suhasini referred to at the beginning of the call. The color we're providing today assumes that the macroeconomic outlook doesn't worsen from what we are projecting today for the current quarter. We expect foreign exchange to continue to be a headwind and to have a negative impact on revenue of about 1.5 percentage points on a year-over-year basis. We expect our September quarter total company revenue to grow year over year at a rate similar to the June quarter. We expect services revenue to grow double digits at a rate similar to what we reported in the first 3 quarters of this fiscal year. We expect gross margin to be between 45.5% and 46.5%. We expect OpEx to be between $14.2 and $14.4 billion. We expect OI&E to be around negative $50 million, excluding any potential impact from the mark-to-market of minority investments, and our tax rate to be around 16.5%. Finally, today our board of directors has declared a cash dividend of 25 cents per share of common stock payable on August 15, 2024, to shareholders of record as of August 12, 2024. With that, let's open the call to questions.
Thank you, Luca. We ask that you limit yourself to 2 questions. Operator?
We've got 7 minutes, guys. Then we're going to Amazon at 5:30.
Certainly. We will go ahead and take our first question from Erik Woodring with Morgan Stanley. Please go ahead.
Great. Thank you very much for taking my question. Maybe, Tim, if we start with you, I thought some of the color you provided before the call about iPhone 15 performing better than the iPhone 14 was interesting. So just with that context, can you maybe help us understand where you see iPhone replacement cycles today, where you think the size of the base of iPhones that are aged and likely to upgrade are, and what that translates to in potential pent-up demand as we enter a new iPhone cycle? And then I have a follow-up. Thank you.
Yes, hi, Eric. The install base hit an all-time high during the quarter, and so we were very happy about that. iPhone in general grew in constant currency, and the 15, as you point out, if you look at the same number of weeks of the 15 from launch and compare that to the 14, the 15 is doing better than the 14. And so that's kind of a state of where we currently are. In terms of upgrade rates, it's very difficult mid-cycle to call upgrade rates. I would just say that with Apple Intelligence, we're very excited and about the level of value that we're going to provide to users. And we believe that presents another reason for a compelling upgrade.
Okay, that's very helpful. Thanks, Tim.
Yeah.
And then second to that, can you maybe dig into the China dynamics a bit? Sales down 6% this quarter, 3% in constant currency, an improvement from last quarter on a tougher compare. That came on the back of some iPhone discounting. So can you maybe just share color on the China market as a whole, how much you believe promotions helped in the quarter, how sustainable this improvement is, and if this performance really changes any of your approach to the China market as we look forward? Thanks so much.
Yeah, Eric, as you point out, we decreased by 6.5% year over year for the whole of Greater China. And if you look at it on a constant currency basis, we declined by less than 3%. So over 50% of the decline year over year is currency related. That is an improvement from the first half of the fiscal year, and so we're happy to see the acceleration. If you look at iPhone in particular for Greater China, the install base set a record. We also, in mainland China, set a June quarter record for upgraders. And so that's a very strong signal. And in fact, from Kantar, the survey from Kantar this quarter showed that iPhones were the top 3 models in urban China. Also, if you look at one of the things we look at is the 15 family compared to the 14 family for the same number of weeks from launch. So this goes all the way back to the September of 23. If you look at that, the 15 is outperforming the 14. And so those are some of the color I would provide. In addition, one of the things that we're very focused on is the level of new customers buying our products. And so if you look at this on the Mac and iPad, in mainland China, the majority of customers are buying for the first time, buying that product for the first time. And the watch, the vast majority of people are buying the product for the first time. And during the quarter, I should say also that iPad returned to growth in Greater China as it did around the world. And so we continue to be confident in the long-term opportunity in China. I don't know how every chapter of the book reads, but we're very confident in the long term.
Great. Thanks so much.
Yeah.
Thank you, Eric. Operator, may we have the next question, please?
Our next question is from Ben Reitzes with Melius. Please go ahead.
Hey, thanks a lot. Appreciate it. Hey, Tim, now that you've launched or announced Apple Intelligence, do you have any ideas on how it may impact services? Would it do you feel like it'll accelerate your services business, augment it, and maybe folks will need to buy more storage and some other things? How are you thinking about it as a catalyst for services into next year? And I have a follow-up. Thanks.
We started the rollout of Apple Intelligence this week with developers. So some of the features are out there as of Monday, and we couldn't be more excited about getting them out there. Obviously, this will enable developers to take their apps to the next level. And so we're taking this first step in getting the beta out there, and we can't wait to see what kind of amazing things they do with it.
Okay, thanks. And then Luca, with regard to gross margin,
I think I'll stop it there, guys. We'll get ready for Amazon. They should be starting pretty soon. Tim Cook, awesome CEO, not the most inspiring speaker. None of those answers are really that interesting, quite frankly. They're giving really cookie cutter surface level answers. Stock's down a little bit after hours, but I mean, overall decent quarter, so nothing too crazy there. Amazon, we need to know about margins, advertising, cloud, bunch of stuff. Jassy was exceptional last time in sharing his AI vision. I expect him to be exceptional again, but I get markets want some more clarity. Amazon currently is down 5%. Apple is down 1.42. And so I guess we'll see what happens with Amazon right now. NVIDIA down 0.4. Robinhood down 0.64. Bitcoin 64.8.
Thank you for standing by.
All right, we're starting.
Good day, everyone, and welcome to the Amazon.com second quarter 2024 financial results teleconference. At this time, all participants are in a listen-only mode. After the presentation, we will conduct a question-and-answer session. Today's call is being recorded, and for opening remarks, I will be turning the call over to the Vice President of Investor Relations, Dave Fildes. Thank you, sir. Please go ahead.
Hello, and welcome to our Q2 2024 financial results conference call. Joining us today to answer your questions is Andy Jassy, our CEO, and Brian Olsavsky, our CFO. As you listen to today's conference call, we encourage you to have our press release in front of you, which includes our financial results as well as metrics and commentary on the quarter. Please note, unless otherwise stated, all comparisons in this call will be against our results for the comparable period of 2023. Our comments and responses to your questions reflect management's views as of today, August 1st, 2024 only, and will include forward-looking statements. Actual results may differ materially. Additional information about factors that could potentially impact our financial results is included in today's press release and our filings with the SEC, including our most recent annual report on Form 10-K and subsequent filings. During this call, we may discuss certain non-GAAP financial measures. In our press release, slides accompanying this webcast, and our filings with the SEC, each of which is posted on our IR website, you will find additional disclosures regarding these non-GAAP measures, including reconciliations of these measures with comparable GAAP measures. Our guidance incorporates the order trends that we've seen to date and what we believe today to be appropriate assumptions. Our results are inherently unpredictable and may be materially affected by many factors, including fluctuations in foreign exchange rates, changes in global economic and geopolitical conditions and customer demand and spending, including the impact of recessionary fears, inflation, interest rates, regional labor market constraints, world events, the rate of growth of the internet, online commerce, cloud services, and new and emerging technologies, and the various factors detailed in our filings with the SEC. Our guidance assumes, among other things, that we don't conclude any additional business acquisitions, restructurings, or legal settlements. It's not possible to accurately predict demand for our goods and services, and therefore our actual results could differ materially from our guidance. And now, I'll turn the call over to Andy.
Thanks, Dave. Today we're reporting $148 billion in revenue, up 11% year over year, excluding the impact from foreign exchange rates. Operating income was $14.7 billion, up 91% year over year, and trailing 12-month free cash flow adjusted for equipment finance leases was $51.4 billion, up 664% or $44.7 billion year over year. As I think about what matters to customers long-term and therefore to Amazon, there's a lot to like about what we're seeing. Starting with AWS, year-over-year revenue growth accelerated again from 17.2% in Q1 to 18.8% in Q2. we're continuing to see three macro trends drive AWS growth. First, companies have completed the significant majority of their cost optimization efforts and are focused again on new efforts. Second, companies are spending their energy again on modernizing their infrastructure and moving from on-premises infrastructure to the cloud. This modernization enables builders to save money, innovate at a more rapid clip, and drive productivity in most companies' scarcest resources, developers. This is the flip I've talked about in the past, where the vast majority of global IT spend today is on-premises, and we expect that to keep inverting over time. With the broadest functionality, the strongest security and operational performance, and the deepest partner ecosystem, AWS continues to be customers' partner of choice and the biggest beneficiary of this flip from on-premises to the cloud. And third, builders and companies of all sizes are excited about leveraging AI. Our AI business continues to grow dramatically with a multi-billion-dollar revenue run rate despite it being such early days. But we can see in our results and conversations with customers that our unique approach and offerings are resonating with customers. At the heart of this strategy is a firmly held belief, which we've had since the beginning of AWS, that there is not one tool to rule the world. People don't want just one database option or one analytics choice or one container type. Developers and companies not only reject it, but are suspicious of it. They want multiple options for flexibility and to use the best tool for each job to be done. The same is true in AI. You saw this several years ago when some companies tried to argue that TensorFlow would be the only machine learning framework that mattered, and then PyTorch and others overtook it. The same one model or one chip approach dominated the earliest moments of the generative AI boom, but we have a lot of data that suggests this is not what customers want here either. And our AWS team is determined to deliver choice and options for customers. You can see this philosophy in the primitive building blocks we're building at all three layers of the Gen AI stack. At the bottom layer, which is for those building generative AI models themselves, the cost to compute for training and inference is critical, especially as models get to scale. We have a deep partnership with NVIDIA and the broadest selection of NVIDIA instances available, but we've heard loud and clear from customers that they relish better price performance. It's why we've invested in our own custom silicon in Trainium for training and Inferentia for inference. And the second versions of those chips, with Trainium coming later this year, are very compelling on price performance. We are seeing significant demand for these chips. These model builders also desire services that make it much easier to manage the data, construct the models, experiment, deploy to production, and achieve high-quality performance, all while saving considerable time and money. That's what Amazon SageMaker does so well, including its most recently launched feature called HyperPods that changes the game in networking performance for large models. And we're increasingly seeing model builders standardize on SageMaker. While many teams will build their own models, lots of others will leverage somebody else's frontier model, customize it with their own data, and seek a service that provides broad model selection and great generative AI capabilities. This is what we think of as the middle layer, what Amazon Bedrock does, and why Bedrock has tens of thousands of companies using it already. Bedrock has the largest selection of models, the best generative AI capabilities in critical areas like model evaluation, guardrails, RAG, and agenting, and then makes it easy to switch between different model types and model sizes. Bedrock has recently added Anthropic's Claude 3.5 models, which are the best performing models on the planet, Meta's new Llama 3.1 models, and Mistral's new Large 2 models. And Llama's and Mistral's impressive performance benchmarks and open nature are quite compelling to our customers as well. At the application or top layer, we're continuing to see strong adoption of Amazon Q, the most capable generative AI-powered assistant for software development and to leverage your own data. Q has the highest known score and acceptance rate for code suggestions, but it does a lot more than provide code suggestions. It tests code, outperforms all other publicly benchmarkable competitors on catching security vulnerabilities, and leads all software development assistants on connecting multiple steps together and applying automatic action. It also saves development teams time and money on the muck nobody likes to talk about. For instance, when companies decide to upgrade from one version of a framework to another, it takes development teams many months, sometimes years, burning valuable opportunity costs and churning developers who hate this tedious, though important work. With Q's code transformation capabilities, Amazon has migrated over 30,000 Java JDK applications in a few months, saving the company $260 million and 4,500 developer years compared to what it would have otherwise cost. That's a game changer. And think about how this Q transformation capability might evolve to address other elusive but highly desired migrations. During the past 18 months, AWS has launched more than twice as many machine learning and generative AI features into general availability than all of the other major cloud providers combined. This team is cooking, but we're not close to being done adding capabilities for our customers.
I don't know if you guys heard that. Here we go. We're back.
For perspective, we've added over $2 billion in advertising revenue year over year and generated more than $50 billion in revenue in the trailing 12 months. Sponsored ads drive the majority of our advertising revenue today, and we see further opportunity there. Even with this growth, it's important to realize we're at the very beginning of what's possible in our video advertising. In May, we made our first appearance at the upfronts, and we're encouraged by the agency and advertiser feedback on the differentiated value we offer across our content, reach, signals, and ad tech. With ads in Prime Video, the exciting opportunity for brands is the ability to directly connect advertising that's traditionally been focused on driving awareness, as is the case for TV, to a business outcome like product sales or subscription signups. We're able to do that through our measurement and ad tech so brands can continually improve the relevance and performance of their ads. While ads have become the norm in streaming video, we aim to have meaningfully fewer ads than linear TV and other streaming TV providers. And of course, for customers preferring an ad-free experience, we offer that option for an additional $2.99 a month. In our stores business, we saw growth of 9% year over year in the North America segment and 10% year over year in the international segment. A few notes on our North America revenue growth rate. First, last quarter's leap day added about 100 basis points of year over year growth. Second, we're seeing lower average selling prices or ASPs right now because customers continue to trade down on price when they can. More discretionary higher ticket items like computers or electronics or TVs are growing faster for us than what we see elsewhere in the industry, but more slowly than we see in a more robust economy. And our continued faster delivery speed is earning us more of our customers' everyday essentials business. Third, our seller fees are a little lower than expected given the behavior changes we've seen from our latest fee changes. While some of these issues compress short-term revenue, we generally like these trends. While consumers are being careful on price, our North America unit growth is meaningfully outpacing our sales growth as our continued work on selection, low prices, and delivery is resonating. So far this year, our speed of delivery for Prime customers has been faster than ever before, with more than 5 billion units arriving the same day or next day. As more customers experience our fast delivery, they look to Amazon for more of their shopping needs, and the continued acceleration of our everyday essentials business is an example of this phenomenon. On seller fees, lowering apparel fees has spurred substantial year-over-year unit growth in apparel. And the incentive we've given sellers to send their items to multiple Amazon inbound facilities so they can save money where they save us effort and money is getting more traction than we'd even hoped. These collective developments will benefit customers in the form of better selection, lower prices, and faster delivery speed. There's no shortage of ideas aimed at improving the experience for stores customers. For instance, we're adding even more value to Prime, recently introducing free restaurant delivery in many of our geos, expanding Amazon's Pharmacy RX Pass to Medicare members. This is a benefit that gives subscribers all-you-can-consume access to the most common generic medications for just $5 a month, and offering a grocery subscription to help save on grocery items when shopping our US and UK fresh stores. As we pursue these initiatives, we remain focused on lowering our cost to serve. We have a number of opportunities to further reduce costs, including expanding our use of automation and robotics, further building out our same-day facility network, and regionalizing our inbound network. With more optimal inbound inventory placement, we expect to enable faster speeds, consolidate more orders in one box, and reduce inventory transfers once items reach a fulfillment center. These cost improvements won't happen in one quarter or one fell swoop. They take technology and process innovation with a lot of outstanding execution, but we see a path to continuing to lower our cost to serve, which, as we've discussed in the past, has very meaningful value for customers in our business. As we lower our cost to serve, we can add more low ASP selection that we can support economically, which coupled with our fast delivery puts Amazon in the consideration set for increasingly more shopping needs for customers. A few other comments about areas in which we're investing. We remain very bullish on the medium to long-term impact of AI in every business we know and can imagine. The progress may not be one straight line for companies. Generative AI especially is quite iterative, and companies have to build muscle around the best way to solve actual customer problems. But we see so much potential to change customer experiences. We see it in how our generative AI-powered shopping assistant, Rufus, is helping customers make better shopping decisions. We see it in how our AI features that allow customers to simulate trying apparel items or changing the buying experience. We see it in how our generative AI listing tool is enabling sellers to create new selection with a line or two of text versus the many forms previously required. We see it in our fulfillment centers across North America, where we're rolling out Project Private Investigator, which uses a combination of generative AI and computer vision to uncover defects before products reach customers. We see it in how our generative AI is helping our customers discover new music and video. We see it in how it's making Alexa smarter. And we see it in how our custom silicon and services like SageMaker and Bedrock are helping both our internal teams and many thousands of external companies reinvent their customer experiences and businesses. We are investing a lot across the board in AI, and we'll keep doing so as we like what we're seeing and what we see ahead of us. We also continue to like the progress in Prime Video. Our storytelling is resonating with our hundreds of millions of monthly viewers worldwide, and the 62 Emmy nominations Amazon MGM Studios recently received is another supporting data point. We recently debuted titles like Fallout, the second most watched original title ever for Prime Video, The Idea of You, which attracted nearly 50 million viewers worldwide in the first 2 weeks on Prime Video, and Season 4 of The Boys, which reached #1 on Prime Video in 165 countries in its opening 2 weeks. And we continue to see momentum in live sports. We recently announced 11-year landmark deals with the NBA and the WNBA. When combined with our original films and shows, partner streaming services, licensed content, and rent-or-buy titles, Prime Video continues to evolve into the best destination for streaming video. And for Project Kuiper, our low Earth orbit satellite constellation, we're accelerating satellite manufacturing at our facility in Kirkland, Washington. We've announced a distribution agreement with Vrio, who distributes DirecTV Latin America and Sky Brazil, to offer Project Kuiper's satellite broadband network to residential customers across 7 countries in South America. And we continue to field significant demand for the service from enterprise and government entities. We expect to start shipping production satellites late this year and continue to believe this could be a very large business for us. I could go on, but we'll stop here. There's a lot to feel optimistic about over the next several years, and the team collectively remains focused on continuing to invent and deliver for our customers in the business. With that, I'll turn it over to Brian for a financial update.
Thanks, Andy. Let's start with our top-line financial results. Worldwide revenue was $148 billion, an 11% increase year over year, excluding the impact of foreign exchange. This equates to a $1 billion headwind from foreign exchange in the quarter, which is about $300 million higher than we'd anticipated in our Q2 guidance range. Worldwide operating income nearly doubled year over year to $14.7 billion, which was $700 million above the high end of our guidance range. Across all of our segments, we remain focused on managing costs in a way that allows us to continue innovating and investing in areas that we think could move the needle for our customers. Starting with the North America and International segments, customers continue to respond positively to our focus on low prices, broad selection, and fast shipping offers. We delivered at our fastest speeds ever so far this year, which helps drive strength in areas like our everyday essentials. These include items like non-perishable foods, as well as health, beauty, and personal care items. And Prime members continue to increase their shopping frequency while growing their spend on Amazon. Overall unit sales grew 11% year over year, which is consistent with our growth rates in Q1 after you adjust for the approximately 100 basis point impact of leap year. North America segment revenue was $90 billion, an increase of 9% year over year. and international segment revenue was $31.7 billion, an increase of 10% year over year, excluding the impact of foreign exchange. North America segment operating income was $5.1 billion, an increase of $1.9 billion year over year. Operating margin was 5.6%, up 170 basis points year over year, and down 20 basis points quarter over quarter. If we look at profitability of the core North America stores business, we actually improved our margin again quarter over quarter in Q2. The overall North America segment operating margin decreased slightly due to increased Q2 spend in some of our investment areas, including Kuiper, where we're starting to manufacture satellites we'll launch into space in Q4. We saw improvements in our cost to serve, driven by our efforts to place inventory more regionally, closer to where our customers are. This resulted in more consolidated shipments with higher units per box shipped. We also saw packages traveling shorter distances to customers, and this also led to better on-road productivity in our transportation network. Our international segment was profitable again in Q2, with operating income of $300 million, an improvement of $1.2 billion year over year. Operating margin was 0.9%, up 390 basis points year over year. This increase is primarily driven by our established countries as we improve our cost structure with better inventory placement and more consolidated shipments. Additionally, our emerging countries continue to expand their customer offerings, leverage their cost structure, and invest in expanding Prime benefits. We are pleased with the overall progress of these countries as they make strides on their respective paths to profitability. Advertising remains an important contributor to profitability in the North America and international segments, and we saw strong growth on an increasingly larger revenue base this quarter. We continue to see opportunities to further expand our offering in areas that are driving growth today, like sponsored products, as well as newer areas like Prime Video ads. Moving next to our AWS segment, revenue is $26.3 billion, an increase of 18.8% year over year, excluding the impact of foreign exchange. AWS now has an annualized revenue run rate of more than $105 billion. During the second quarter, we saw continued growth across both generative AI and non-generative AI workloads. We saw companies turn their attention to newer initiatives, bring more workloads to the cloud, restart or accelerate existing migrations from on-premises to the cloud, and tap into the power of generative AI. AWS operating income was $9.3 billion, an increase of $4 billion year over year. It's driven by our continued focus on cost control, including a measured pace of hiring. Additionally, AWS operating margin includes an approximately 200 basis point favorable impact from the change in the estimated useful life of our servers that we instituted in Q1. As we've long said, we expect AWS operating margins to fluctuate over time, driven in part by the level of investments we're making at any point in time. We remain focused on driving efficiencies across the business, which enables us to invest to support the strong growth we're seeing in AWS, including generative AI. Now let's turn our attention to capital investments. As a reminder, we define these as a combination of CapEx plus equipment finance leases. For the first half of the year, CapEx was $30.5 billion. Looking ahead to the rest of 2024, we expect capital investments to be higher in the second half of the year. The majority of the spend will be to support the growing need for AWS infrastructure as we continue to see strong demand in both generative AI and our non-generative AI workloads. For the third quarter, specifically, I'd highlight a few seasonal factors to keep in mind. First, we hosted another successful Prime Day in mid-July. It was our 10th Prime Day and was our largest ever. Prime members globally saved billions of dollars on deals across every product category. From a profitability perspective, we've historically seen a headwind to operating margin in Q3, driven by Prime Day deals, as well as the marketing spend surrounding the event. Additionally, in Q3, we also begin to ramp up our capacity to handle Q4 holiday volumes in our fulfillment network. And lastly, we expect an increase in digital content costs quarter over quarter from the return of our NFL Thursday Night Football. We remain heads down, focused on driving a better customer experience. We believe putting customers first is the only reliable way to create lasting value for our shareholders. With that, let's move on to your questions.
At this time, we will now open the call up for questions. We ask each caller to please limit yourself to one question. If you would like to ask a question, please press star one on your keypad. We ask that when you pose your question, you pick up your handsets to provide optimum sound quality. Once again, to initiate a question, please press star, then one on your touchtone telephone at this time. Please hold while we poll for questions. And our first question comes from the line of Eric Sheridan with Goldman Sachs. Please proceed with your question.
Thanks so much for taking the question, and thanks for all the detail in the prepared remarks. Maybe a two-parter on AWS. There's been a theme during the last couple of weeks of earnings of the potential to overinvest as opposed to underinvest in AI as a broad theme. I'm curious, Andy, if you have a perspective on that in terms of thinking about elements of capitalizing on the theme longer term against the potential for pace and cadence of investment behind AWS as a segment. And the second part would be coming back to your comments on custom silicon. How do you feel about custom silicon, both from a pace of investment and then more broadly, how you think about it as a return profile on a pivot to more custom silicon in your portfolio over the medium to long term? Thanks so much.
Thanks, Eric. I'll take them in order. I think on the question about investment in AWS and on the AI side, I think where I'd start is I think one of the least understood parts about AWS over the last 18 years has been what a massive logistics challenge it is to run that business. If you think about the fact that we have about 35 regions, and think of a region as a cluster of multiple data centers, and then about 110 availability zones, which is roughly equivalent to a data center. Sometimes it includes multiple. And then if you think about having to land thousands and thousands of SKUs across the 200 AWS services in each of those availability zones at the right quantities, it's quite difficult. And if you end up actually with too little capacity, then you have service disruptions, which really nobody does because it means companies can't scale their applications. So most companies deliver more capacity than they need. However, if you actually deliver too much capacity, the economics are pretty woeful and you don't like the returns of the operating income. And I think you can tell from having, we disclose both our revenue and our operating income in AWS that we've learned over time to manage this reasonably well. And we have built models over a long period of time that are algorithmic and sophisticated that land the right amount of capacity. And we've done the same thing on the AI side. Now, AI is newer, and it's true that people take down clumps of capacity in AI that are different sometimes. But it's also true that it's not like a company shows up to do a training cluster asking for a few 100,000 chips, the same day. Like you have a very significant advanced signal when you have customers that want to take down a lot of capacity. So while the models are more fluid, it's also true that we've built, I think, a lot of muscle and skill over time in building these capacity signals and models. And we also are getting a lot of signal from customers and what they need. I think that it's, the reality right now is that while we're investing a significant amount in the AI space and in infrastructure, we would like to have more capacity than we already have today. We have a lot of demand right now, and I think it's going to be a very, very large business for us. On the custom silicon point, it's really interesting what's happened here, and it's also our strategy and approach here has been informed by running AWS for 18 years. When we started AWS, we had and still have a very deep partnership with Intel on the generalized CPU space. But what we found from customers is that when you find an offering that is really high value for you and high return, you don't actually spend less, even though you're spending less per unit. You spend less per unit, but it enables you and frees you up to do so much more inventing and building for your customers. And then when you're spending more, you actually want better price performance than what you're getting. And a lot of times it's hard to get that price performance from existing players unless you decide to optimize yourself for what you're learning from your customers and you push that envelope yourself. And so we built custom silicon in the generalized CPU space with Graviton, which we're on our 4th model right now. And that has been very successful for customers and for our AWS business, as it saves customers up to about 30 to 40% in price performance versus the other leading x86 processors that they could use. And we saw this same trend happening about 5 years ago in the accelerator space, in the GPU space, where the products are good, but there was really primarily one provider, and supply was more scarce than what people wanted. And our customers really want improved price performance all the time. And so that's why we went about building Trainium, which is our training chip, and Inferentia, which is our inference chip, which we're on the 2nd versions of both of those. They will have very compelling relative price performance. And in a world where it's hard to get GPUs today, the supply is scarce and all the schedules continue to move over time. Customers are quite excited and demanding at a high clip our custom silicon, and we're producing it as fast as we can. I think that's going to have very good return profile, just like Graviton has. And I think it will be another differentiating feature around AWS relative to others.
And our next question comes from the line of Brian Nowak with Morgan Stanley. Please proceed with your question.
Thanks for taking my questions. I have two. So the first one I wanted to ask about, in the second quarter, the retail gross margins, if we're trying to do the monkey math, look a little weaker than expected. Was there any extra pressure on retail gross margins because of discounting, or is that where Kuiper is? Or sort of how do we think about some of the drivers of retail gross margins in the quarter X shipping? And the second one, Andy, in the past, you talked about cost to serve improvements and sort of getting the North America margins back to pre-pandemic levels. Can you just remind us again, sort of the internal philosophy about executing on that? Is there a timeline to deliver on that? Sort of how are you sort of balancing showing that profitability improvement over the next couple of years versus pressing on new investments like Kuiper and perhaps reinvesting some of those profits over the next couple of years?
Hey, Brian, let me start with the first question on North America margins. So if you look at the segment operating margins, we did decrease 20 basis points sequentially from Q1 to Q2. I'll remind you that we have to see the annual step up in stock-based compensation at the end of Q1 each year, and that added about $1.8 billion of stock-based comp expense in Q2 versus Q1. So that's impacting, to some extent, all three segments. But even with that stock-based comp step up, the stores part of the North America segment increased the margin again last quarter. So we're continuing to see strong improvements in cost to serve, as well as improvement in speed, added selection, better safety. So a lot of the key areas that we're hitting on are strong. What you're seeing for the segment is that some of our investment areas had a tick up in expenses and investment in Q2 versus Q1. That's not unheard of. Q1 is usually the lightest investment quarter. Things like Prime Video and devices have less, investment going on in those quarters. But the one thing I'd point out, I think we mentioned it, is Kuiper is stepping up a bit in Q2 versus Q1 as we start to build satellites that will launch in Q3 and Q4 this year.
On your second question, Brian, I continue, and the team continues to believe that we have the opportunity to expand the margin in our stores business. And as I've said on a number of the calls that we've done, it's not going to happen in one quarter. It's not going to happen in one fell swoop. It's going to take work over a long period of time. But I think that one of the silver linings, if you will, about a year and a half ago and the ricochet of the pandemic and all the growth that we had and the cost to serve challenges that we had was it really forced us to reevaluate everything in the network and really even our most closely felt beliefs over a long period of time. And what it did was it unveiled a number of opportunities that we believe we have to keep driving cost to serve down. And the first one that you've seen play out over the last year or so has been the regionalization of the U.S. network.
And I think one thing to remember about that is that while it's had even bigger impact than maybe we theorized when we first architected it, we're still not done fully honing it. There's a lot of ways that we continue to optimize that U.S. regionalization that we think will continue to bear lower cost to serve. But at the same time, we found a number of other areas where we believe we can take our costs down while also improving the customer experience. One of the great things about regionalization was it not only took our cost to serve down, but it meaningfully changed the speed with which we're able to get items to customers. And so we have a number of those other opportunities. Another example of that is regionalizing our inbound network, which is also going to lower our cost to serve and get items more close to end users and diminish the amount of time it takes to get them to customers. We have a number of things that we're working on that allow us to combine more units per box, which lowers our costs as well. And a lot of customers like that better because it's better for the environment having more units per box. So I think we have a lot of opportunities to continue to take down our cost to serve. And strategically and philosophically, just two other things, as you were alluding to that question. I think that from our perspective, as we're able to take cost to serve down, it means that we're able to afford to have more selection that we're able to offer to customers. And there are a lot of lower ASP items today, or average selling price items, that we don't stock because they're not economic to stock with our current cost to serve. But as we work hard and make progress like we are on lowering our cost to serve, that allows us to add more selection. And we see this time in and time out that when we add more selection, customers actually consider us for more of their purchases and spend more with us down the line. I think the other thing too I would tell you is that I don't see it as being binary in any way, nor have I really ever seen it this way in the history of the company. I've been here 27 years, but we don't think of it as we can either be investing or we can be working on trying to take our cost to serve down. We believe we can do both. If you think about the examples you gave, the stores business and the Kuiper business they're just different people working on those businesses. So our stores team is going to continue to work really hard on expanding selection and keeping prices low and speeding up our delivery times and driving our cost to serve down, while our Kuiper team is working on how to figure out how to help the 400 to 500 million households around the world who don't have broadband connectivity get that connectivity and allow them to do a lot of the things we take for granted today with broadband connectivity. So they're not going to be binary. We're going to work on them both at the same time.
And our next question comes from the line of Mark Mahaney with Evercore. Please proceed with your question.
Hey, thanks. I'll ask two questions. AWS, those three factors that are causing that kind of acceleration in Q2 and recovery in growth rates from a year ago, those sound sustainable? Is there any reason that we shouldn't see sort of ongoing, acceleration at some level through the back half of the year? And secondly, I just want to ask about a small segment of pharmacy. It seems to me like, at least anecdotally, I've seen you lean in more into marketing for that, and survey work suggests to us that there's kind of greater consumer interest in that. Just talk about where that business is, for you, and is it at a point where you feel like you've moved beyond early adoption and are leaning into kind of getting more mass Amazon customer adoption? Thank you.
On the AWS question, it's always hard to predict what the growth rates are going to be, and it's a relatively large business at $105 billion revenue run rate at this point. But I do think that we have seen the lion's share of the cost optimization happen, and I also do believe that pre-pandemic we were on this march where most companies were trying to figure out how to modernize their infrastructure, which really means moving from on-premises to the cloud because they can save money and invent more quickly and get better developer productivity. And then the pandemic happened and people were in survival mode, and then a difficult economy came and people were trying to save money. And we just see people going back to asking themselves, why aren't we taking this low-hanging fruit here? I mean, I don't want to run my own data centers. I can actually be more cost effective and invent more quickly for my customers if I'm using the cloud. And AWS, with just a lot more functionality, stronger operational performance and security, which really matters to customers as well, and a deeper partner ecosystem continues to be the partner of choice as people are moving to the cloud. And
I think the generative AI component is in its very early days. It's as I said, we kind of sometimes look at it and say that's interesting that we have a multi-billion-dollar revenue run rate already in AI, and it's so early. But if we look at the amount of demand that we have from customers right now, it's very significant. So I think all three of those things have a chance and will likely continue over time, and we'll see where that growth rate nets out over the next number of years. I think that one other thing I would say about that too, Mark, is that the business today, as I mentioned, it's a $105 billion revenue run rate business. About 90% of the global IT spend is still on premises. And if you believe that equation is going to flip, which I do, there's a lot of growth ahead of us in AWS as the leader in all those dimensions I mentioned. But I also think that generative AI itself and AI as a whole, it's going to be really large. I mean, it is not something that we originally factored when we were thinking about how large AWS could be. And unlike the non-AI space, where you're basically taking all of this infrastructure that's been built on premises over a long period of time and working with customers to help them migrate it to the cloud, which is a lot of work, by the way. In the generative AI space, it's going to get big fast, and it's largely all going to be built from the get-go in the cloud, which allows the opportunity for those businesses to continue to grow. On the pharmacy side, I think you're right that you're seeing that business continue to grow and to get more resonance with customers. And I think it was always a relatively natural extension for us to build a pharmacy offering from our retail business. But I think a lot of what you've seen, the business has grown really quickly. A lot of what you've seen is that the work that the team has done on the customer experience over the last 18 months has really paid off. Customers love the customer experience of Amazon Pharmacy. And, especially, by the way, when you think about the experience and the speed and ease with which you can order versus walking into a pharmacy in a physical store. If you walk into pharmacies in cities today, it's a pretty tough experience with how much is locked behind cabinets, where you have to press a button to get somebody to come out and open the cabinets for you, and a lot of shoplifting going on in the store. So the combination of what's happening in the physical world and how much improved we've made our pharmacy experience is driving a lot of customer resonance and buying behavior. I think also you see us continuing to expand there. We expanded our XPass package and program to Medicare members. And that program allows customers and Prime members to be able to get up to 60 common medications for just $5 a month. And we continue to launch same-day delivery of medications to cities. We have them in 8 cities, including Los Angeles and New York today, with plans to expand to more than a dozen cities by the end of the year. So we're seeing a lot of growth there, and we're very optimistic about it.
Our next question comes from the line of Brent Thill with Jefferies. Please proceed with your question.
On AWS, I'm curious if you had a backlog number you could share for the quarter. And I guess, Andy, when you think about getting the data estate ready, I know AI today is early, but when you see most of these companies are having to move to public cloud, are you seeing a step up and a return to workloads moving to get ready for this data estate, even if they're not ready to adopt AI? What are you seeing in those sales motions? Thank you.
Hey, this is Dave. I'll just start off just to give you the backlog figure. So at the end of the second quarter, it was $156.6 billion. So that's up about 19% year over year.
On the second part of your question, Brent, what I would say is that it's true in analytics, but it's even maybe more so true in AI, which is that it's quite difficult to be able to do AI effectively if your data is not organized in such a way that you can access that data and run the models on top of them and then build the application. So when we work with customers, and this is true both when we work directly with customers as well as when we work with systems integrator partners, everyone's in a hurry to get going on doing generative AI, and one of the first questions that we ask is, show us where your data is, show us what your data lake looks like, show us how you're going to access that data. And there's very often work associated with getting your data in the right shape and in the right spot to be able to do generative AI. Fortunately, because so many companies have done the work to move to the cloud, there's a number of companies who are ready to take advantage of AI, and that's where we've seen a lot of the growth. But also it's worth remembering that, again, remember the 90% of the global IT spend being on premises. There are a lot of companies who have yet to move to the cloud who will, and the ability to use AI more effectively is going to be one of the many drivers in doing so for them.
And the next question comes from the line of John Blackledge with TD Cowen. Please proceed with your question.
Great. Two questions. First, the AWS op income margins were strong, again, mid 30% area. Just kind of what were the key drivers, and how should we think about AWS margins in the back half of the year? And then the international op income margin stepped down a bit, Q over Q. Just curious about that. Thank you.
Yes, thank you, John. Let me start with AWS profitability. So, yes, the margin is in the mid-30s % range in Q2. It's up from the mid-20% range last year. So you're seeing the impact of a number of cost reductions that we've made and efficiencies we've driven in the business. There's also an adjustment that we made to the useful life of servers that happened in Q1. We talked about last quarter. That contributed about 200 basis points of margin year over year. So we continue to work on the cost structure. But again, as we said in the past, the operating margin will fluctuate. It'll be lumpy quarter to quarter. We continue to work to build new products that attract new customers and work on our efficiencies. Second question was?
International segment margin. Yeah, this is Dave. Just real quick on that. You mentioned we're at about $300 million profit for the quarter. That is up about 390 basis points year on year from a margin perspective. And as we talked about in the past, there's a number of countries at different stages of existence and maturity there. And so I think you're seeing continued progress, certainly on a year-over-year basis, with both our established countries, so the UK, Germany, and Japan, in particular, being sizable contributors to that business. Continued improvement and build out there, similar to the factors we talked about with the US, focused on operational efficiency while expanding the customer experience. And then in the emerging countries, as we've said over the past several quarters, we launched about 10 countries over the last 7 years, really focused on, again, expanding that customer experience, building out the Prime member benefits while building scalable solutions for customers. And so I think in both that established and emerging areas, seeing good progress year over year and working for further improvement there.
And our final question will come from the line of Doug Anmuth with JP Morgan. Please proceed with your question.
Thanks for taking the questions. You had factored in some macro and discretionary pressures into your 2Q guide, especially in Europe, and I think you called out computers, electronics, and maybe TVs in 2Q as well. I'm just curious, were the macro trends generally as you expected, or did you see softening through the quarter, and kind of how does that influence your 3Q outlook? And then separately, Brian, can you help us quantify the incremental investment around Kuiper that you talked about? Thanks.
Yeah, sure. Thank you, Doug. The macro factors, if I step back, I think Andy discussed it earlier as well. We're seeing a lot of the same consumer trends that we have been talking about for the last year. Consumers being careful with their spend, trading down, looking for lower ASP products, looking for deals. That continued into Q2, and we expect it to continue into Q3. We're seeing signs of it continuing in Q3. The difference in Q2 was that, again, we had very strong unit volume growth. We actually slightly accelerated when you adjust for leap year in North America unit growth in Q2. So the drop in revenue growth sequentially was tied to ASP, and both continuation of existing trends, but also, as we talked about, growth in our everyday essentials business and categories. So while we think we are selling a number of higher ticket items, certainly and holding up well in the market itself, it's certainly not as strong as it's been in a normalized economy. And so it's lower ASP products are more the mix right now, and we like that because again, our speed allows us to deliver, especially everyday essentials, quickly, and we like being in the consideration set for consumers on those items. We're not going to quantify Kuiper today, but thank you for your question.
And thanks for joining us today on the call and for your questions. A replay will be available on our investor relations website for at least 3 months. We appreciate your interest in Amazon and look forward to talking with you again next quarter.
All right, folks, that is Amazon. All right, so I thought the call actually went pretty damn good. I thought Jassy always crushes it explaining the kind of key elements of how to think about Amazon and how to think about the broader business. Unfortunately, market doesn't agree with him right now. That's okay. I think eventually the market will. Super bullish Amazon right now, short term. Small headwinds. I don't even want to fully call them headwinds because they're very minute issues. But if your stock's up 30% year to date, those minute issues are going to cause some issues. So Amazon right here down 6.63%, 171.85. I have no idea tomorrow if it drops below 170 or if it bounces from 170 upwards. If I had to guess, maybe a bounce just because the entire market was red. So you would think we get a little bit of relief tomorrow. Tomorrow is a Friday, though. On a Friday, you tend to see a bit of more of a sell-off. And that could lead to potential more pain in the broader NASDAQ. QQQ after hours right here, down 0.68%. S&P 500 down 0.46%. Apple right here, up 0.6%. Robinhood down a little bit after hours. Bitcoin apparently is doing its thing right now, 65.4. But Amazon's still down 6%. Now, the big thing I got from the Amazon earnings call was that they have a vision for AI. We'll talk about Intel in a second. Stock market news, what's up? Thank you for being here. We'll talk about the problem with Intel in a minute, mainly pausing their dividend. But Amazon has a real vision for AI. One of the notes I took when Jassy was speaking was that he talked about the logistical challenges of building out the servers necessary to serve out AWS to all their clients. And he says, look, if you have too much server capacity, the unit economics on the operating margins get really bad. If you have too little server capacity, obviously companies can't scale their usage of AWS to build applications. So that's a very unique challenge. And the reason he brought this up was because they're having the same challenge with AI. How much of an AI server build out do you need to deliver the AI cloud that AWS offers to their clients in a meaningful way? Or how little do you need to make sure the unit economics of that make sense? All in all, when he was talking about that, that gave me even more insight that Jassy understands what the hell he's doing. He's not wasting money. He's not burning money. He has a very meticulous focus, and they have unique algorithms to actually help them figure out this stuff in regards to how to do this properly. And that's why AWS is growing 19% year over year, $100 billion TTM run rate. The only problem is it's not enough for the street at this moment. And it's the same thing that same things that Zuck said as well. Zuck said, hey, we're building out our CapEx, and obviously we are going to need years to monetize AI. Jassy said, you're going to need some time. If he said years, he would have matched Zuck's, but he said you're going to need some time to really see the build out of monetization on AI. Now, one of his examples for monetizing AI was Amazon Q. For those that don't know Amazon Q, I covered it a couple months ago. Amazon Q is kind of their version of like a pseudo co-pilot inside of your business. That's something you can chat to and then, be able to get insights from your data. He said Amazon Q is actually helping them become very productive in terms of coding internally in Amazon. Something similar to a little bit of what GitHub Copilot offers from Microsoft. So the vision for advertising was very clear. The vision for the AI server build out was clear. The vision for the CapEx build out was very clear. Their collaboration with NVIDIA and the demand for the chips that they have also very clear. The only problem, in my opinion, for why Amazon is down is that their operating margins have taken a hit. And those operating margins taking a hit quarter over quarter is not necessarily the best thing, along with the ads business missing against analyst expectations. But let me be clear, I do not think this was a bad quarter. at all. At all. I thought this was a phenomenal quarter. You can't ask that much out of Amazon given where they are in terms of the comps they have at this point of the business. But certain metrics are, you just can't miss on those. And unfortunately, I think they missed on those metrics. Now, a lot of people might say, well, the operating income going down to 9.9% is not that big of a deal because you're looking at quarter over quarter, not year over year. I disagree. And if I'm going to have to be contrarian here, then I'll be contrarian. I think a lot of the people that are trying to justify this 10.7 going to 9.9, look at the last 5 quarters, 3.7, 5.7, 7.8, 7.8, 10.7. It was going up quarter after quarter after quarter after quarter. Boom, you get a reversal to 9.9. Although the street expected 9.2 and they beat those expectations, one thing the street also hates is when you reverse a trend, because that signals that maybe there's going to be some issues going into the next few quarters where you can't sustain the momentum. And if they're valuing you on your future growth, your future cash flows, that is where they can get a bit upset. So although I don't think this is the biggest deal, I think if that 9.9 was 10.7 or 10.8, that would be the headline on CNBC tomorrow. Amazon posts highest operating income margins in 3 years, or at least sustains their highest operating income margins in 3 years. And that helps the stock a lot more. The advertising reason to sell off the stock, missing expectations, I think that's a bullshit reason. I really don't think the street is like, oh my God, they missed on their ads, even though they're growing 20% year over year. Ads is a big part of their business. It's not the only part of their business like Meta. If Meta missed on ads, that would be a collapse of their stock, because their entire stock, 99% of the revenue is ads. So I think it's the operating income margins. I mean, I'm curious what you guys think for why they fell. It wasn't cloud, obviously. You could point to advertising. I think that's BS. Maybe you can point to subscription revenues not being up as much as they need it to be. But to me, it's about, can they make money off the revenue they're generating? And I don't think the revenue they're generating is getting the margins that the street wants. 7.8 is the same as 7.8, correct, but it wasn't decreasing. This is the first quarter in 5 quarters you see a decrease. And, that is the issue. Did you not listen to the answer about their margins on the call? No, they had a good answer. Again, this is the problem with Amazon. They always have good answers. Jassy knows exactly what he's doing, and his explanation on this was fantastic. The problem is the numbers are the numbers. And so, at the end of the day, the number is the number. If the street doesn't like the explanation, or they just don't like the fact that there was a reversal, they're going to sell you off. Now, Amazon right here down 7%. Again, if you're long-term on Amazon, I think this is a blip in the radar, and you hold for the next decade, because Amazon is one of the most amazing companies out there. However, if you care about the short-term movement, Jassy could say whatever he wants. It was not enough for the street to feel that operating margins were going to increase anytime soon. And again, if it takes some time for operating margins to get closer to 15%, well, the street's just going to be like, all right, well, why do we give you the multiple until you show us the profits? And that might create a great buying opportunity for Amazon. It's just not going to jump up to $200, unfortunately. At least not now. Think missing revenue by 600 million will obviously be a reason for the sell-off. Yeah, I mean, look, the miss on revenue to me is definitely not amazing. I don't know if that is the reason they sell this thing off almost 8%. I mean, at the end of the day, Amazon is putting up crazy numbers. Like Walmart, Amazon, they're putting up $150, $160 billion a quarter. If you're up or down on some of those numbers, that sucks. I don't know if that's the number one reason they take you down, especially if it's not a gigantic miss. Like 600 million for them is quote unquote gigantic to us, but percentage wise, it's relatively insignificant in terms of what they're doing, especially when AWS was thriving. Now, if they missed on AWS revenues, I would agree with you. This thing would probably be at the 150s right now, because AWS has no room for error, along with GCP and Azure, which GCP and Azure have not shown any error, which has been amazing. And neither has AWS. But I think the broader operating margins are the issue is right now. Now, does that mean they get rid of 2-day shipping? Or they're not going to do that? Does that mean they stop 1-day shipping? Does that mean, what do they do to get those margins up? They're going to have to figure that out over time. And again, they have some specific plans, particularly for how they build out the server structure for AWS, because that'll help with the margins as well. But we're going to need an answer eventually. And, or not just an answer, but an execution against that answer. And other news, Intel, someone bought $700,000 of Intel at $30 this morning. And they bought 22,987 shares, 99% of their portfolio. They are down $150,000 after hours, which sucks. That's not the best. Their logic The grandmother died 2 months ago. They left him $800,000 as an inheritance. He's a junior in college with a math major. He doesn't have any use for the money, nor do I have debt. So he said Intel is going to be one of the key semiconductor manufacturers in the United States. This was his thesis. This is on Wall Street Bets. And that's what happened. So that sucks as well, dude. I mean, forget Amazon. If you have some Amazon, I mean, it sucks being down 6%, but Amazon, we all know it's going to be a $300 stock eventually, if not in the next couple of years. Intel and full porting on Intel. I don't know how quick that comes back. Again, Intel down 20%. It's down 20% for some crazy reasons. They're firing 15,000 people. They're pausing the dividend, and they're not going to be profitable for a couple of years. So if I had to bet that Intel was coming back to 30 anytime soon, I mean, maybe if we have a little bit of a rally, but it like the dividend pause to me is the thing that makes the street really upset. And if they're not getting a dividend from it, like if you're not getting a dividend from any company, you're hoping the stock goes up. That means their growth has to be there. They're not growing at all. And they're not profitable on the one part of the business that should be growing a lot over the next couple of years. So that's tough. That's tough. I don't know if Intel recovers from this that soon. I think Intel will be back to $30. I think he'll make back his $150K. It just might take some time. Now, if I was in that position, I would sell covered calls that are aggressive on Intel. The problem is if you sell covered calls at $25 and then the thing runs to $25 and you lose your shares at $25, you're still taking a $5 loss. So when a stock falls below your average and you sell covered calls against it to reduce your cost basis, you have to make sure that the stock overall does not collapse does not rise up above your covered call strike, because then you might be stuck with having to sell those shares. So that would be my solution. I wouldn't do it with all the shares. I would start doing it in tranches and trying to see if the price action was good. But I do think he could have picked something else for the 700,000. I mean, if someone gives you 700 grand, also, dude, he should have just sold puts on it. Like he should have sold puts on it and at least got paid to buy the shares before he just bought them. And this is why I think selling options is, if you had $700,000 and you wanted to go all in on one stock, I think the first thing you do, unless the stock is egregiously undervalued, is you sell puts on it. You get paid to wait. You don't sell $700,000 worth of puts. You sell, $50,000 worth of puts. Just see like where the stock goes, and then you DCA into a position. But going all in, like just throwing a 700 grand into that's tough. If you do that with something like a Palantir or an Amazon and you're down on it, then like it's probably going to recover quicker just because of those stocks are a bit different than Intel. But Intel's a tough one. So I would put some in the Qs and don't look. Yeah, that's another. The other thing is like, dude, just like put some in the ETF, dude. Like put some in fucking SPY. put some in something else. Like out of all the names, Intel is the one that hurts. Like if this was Google or something and Google fell 10%, it's like, all right, dude, whatever. It's like not that big of a deal. It's Amazon, Nvidia. Even if it was Nvidia at 120, Nvidia goes to 100. It's like you have a pretty good shot of that coming back. Intel, I think it comes back. It might just take some time, dude. Pausing that dividend is a very, very big deal. So yeah, I think DCAing versus lumping would have been the strategy there. The other hard part is that's his grandmother's money. And I think the real lesson here is when it's not your money, you're more careless. I think that's everybody, and that's a lesson he's learning in his life. I've learned that lesson. Like when you're managing other people's money to any extent, even if your mom just gave you $100, right? And you're like, you have to spend that. Like you're more meticulous when it's your 100 and you worked for it versus getting it from someone else. Snapchat after the bell, still taking a hit. Snapchat right here down 17%. At least he didn't put it in Snapchat. I think Intel, a little bit better prospects than Snapchat, even though I think Snapchat could turn that entire business around if they just changed a few things. But Evan Spiegel is running it his own way. But at the end of the day, that's what we got right now in the broader markets. Overall, final thing on Apple, I thought Apple has a good earnings as well. They beat on top and bottom line. They're still growing. China has a little bit of issues, but that's okay. The street expected that. The stories about the iPhone, I didn't get to listen to the whole call, so I'll listen to the call in a little bit and try to figure out what's going on with the call. But you can see right here, iPhone still 39 billion, Mac, slight miss, iPad beat, wearables beat, services beat, and then gross margins beat as well by 0.2%. Another thing is Michael Saylor put out earnings. He said, we continue to closely manage our equity capital and are filing a registration statement for a new $2 billion at-the-market equity offering program. It looks like he's getting ready to buy another 2 billion of Bitcoin. Maybe that's also helping Bitcoin, and that's why Bitcoin is going up right now. But overall, earnings today, a bit crappy based on what we got. CrowdStrike as well, yeah. I mean, dude, I would have bought CrowdStrike over Intel, quite frankly. Like, at least you're getting a bit of a discount on CrowdStrike. But yeah, CrowdStrike looks like it's going to the 200s, and it'll give us a good opportunity. But it looks like it's going to take some time for that one to recover as well. All right. What are you guys thinking? Last couple minutes. What are you guys thinking? What are you thinking? How are you dealing with today? I'll have more updated thoughts tomorrow morning. Also, TJ will be on tomorrow. We'll discuss. We have some Intel shares in the public portfolio. We closed out our puts on Meta. Thankfully, we did that really quick, and that was a really important, good move we made before Meta collapsed. But yeah, overall, it was a rough day. I'm curious tomorrow, do we rebound from this day, or does the day kind of just like, does the pain compound on each other? You know, because tomorrow's, I mean, it's a Friday. It'll be very telling if the pain compounds and shit's getting bad and like the narrative's forming, is the selling has just begun in August, or a little bit of a rebound. Iran might attack tonight. I don't know if they will, but there are rumors of that. Big gold hit an all-time high yesterday at 2,500. Right now it's at like 2,450 or something. So gold's going up as a hedge against geopolitical instability. Yeah, if he full ported Tesla too, that would have also been, or just sold some cash secured puts on Tesla. You know, you would have got paid a juicy premium on those. And if Tesla really did fall to like the low 200s, if you have to buy Tesla, that's all right. Fuck it, buy some Tesla. Start red, recover by end of day. Maybe that's possible. Q's dropped. Nvidia just sat at 107. Well, remember, Nvidia was at 120 this morning in the pre-market, so it fell with the Q's as well, even though it went up 12% yesterday. Dead cat bounced. If tomorrow's green, it's very possible that could also happen. I think we need a couple more days of earnings. Remember, the reason today really we took some pain outside of Amazon and those operating margins is because of jobless claims that came in worse than expected, along with ISM data that came in the worst since June of 2020. When you've got that type of data baked in, yeah, things can get bad. Now, was 565 on the S&P a top? I don't know. IWM as well. I mean, the Tom Lee trade, that's not going good at all. That one got hit 216.51, down 3.25% of the day. Tom Lee said expect a 5% rally post JPOW. If we come through up 5% after all of this, he's going to look pretty good on that call. The question's just, what are the catalysts now, given all the bad data macroeconomic wise we got this morning? So I guess we'll see. Can you imagine if Iran really attacks? Yeah, it would just be more pain that we have to deal with. Bitcoin's up right now. Maybe Bitcoin's hedging against it. Usually during the geopolitical instability, Bitcoin falls. So I'm confused why Bitcoin is up right now, but Bitcoin took a nasty beating this morning. It went to 62,000, which was not fun either. Jobs report tomorrow. Yeah, I forgot. Yeah, non-farm payroll. So if unemployment, well, that's another. So bad news is bad news now. It's not good news. So like 3 months ago, I would want unemployment to be up, even though that sucks for people losing their jobs. But at the end of the day, inflation had to come down. Now, tomorrow, if people keep losing their jobs, you never know. Markets might say, all right, it's like really getting bad. Granted, unemployment, let's say it goes to 4.2 up from 3.4. Yeah, that's bad. But that's not like 6, 7, 8% unemployment. So the question is, how do we quell that? You quell that by cutting rates. Would JPOW do an August emergency rate cut? I think he's allowed to. I don't think he's going to do it. But at Jackson Hole, which he speaks every August, if he signals that, hey, it's time for us to cut rates in September, maybe the market fully starts getting ready for the rate cut, because he's allowed to signal. Like, remember, his words really matter. So on the current call, he sounded dovish, but he was still like hindering his dovishness. In August at Jackson Hole, he might just straight out basically tell us he's going to do it without literally saying that final sentence. And that could cue up a September cut, and we actually get a real September cut. So we'll see. And again, the earnings have been good for big tech. Amazon were great earnings outside of my concerns around operating margins, but at the end of the day are a blip in the long-term radar. Earnings are great. Apple earnings are fine. Meta, phenomenal. Google, Microsoft, great. We have Nvidia left. Tesla was whatever, but Tesla's a different story. Big tech put up the numbers. As long as the rate cut leads people to believe that big tech having those numbers and unemployment being quelled by a rate cut could cause a melt up ultimately, especially where there's not many other places to put your money in because your yield is decreasing. I think that brings money back to the markets. along with all of the banks and the analysts. You can believe them or not believe them, but they are still pretty bullish. I mean, when they start turning, maybe we've either hit a bottom or maybe we start to see a real market meltdown. But pretty much, I mean, Meta got upgraded to 650 every day by like 7 different firms. You could say that's BS or not, but like at the end of the day, those numbers justify a higher multiple. It's just if we get into a recession, everything changes, right? And we need the data to figure out if that recession actually happens. Amazon 170, yep. What do you, real quick before I leave, what do you guys think is the reason why Amazon's down right now? I'm curious. I'm actually curious what other people think, because my argument is operating margins. I know not everyone agrees. Yeah, look at that, 169 on Amazon. I am trying to rationalize what the other people think out there for why Amazon is down. Because I'm curious, because I know a lot of people don't agree that it's just about the margins, but then what exactly causes a 7% decline on Amazon? Q3 guidance, yeah, guidance could be one reason. 7% is a lot for the guidance. I mean, that's close to that's about that. Yeah, that's round about $120 billion in market cap for a little lowered guidance. Street just wants a reason to sell. It's the narrative, bro. That could be a reason. Do you think the market will freak out if Powell announces a rate cut in August? Kind of, because then he's admitting defeat against a recession. So maybe it's not the most bullish. I think it would be good, but he would definitely be signaling shit's hitting the fan if he does it in August, which is another reason he might not want to do it. Revenue miss, can't have a 40 forward PE and miss on revenue. That is fair. That is fair. Market sentiment and momentum. I do agree it's an excessive sell-off. Whether it's operating margins, the revenue miss, the forward PE being a bit frothy, I do still think it was already down 2% in the day. So you're talking about basically a 9.3% decline on Amazon for the whole day. People see shit is slowly coming for the fan. How crazy is that, right? If shit is coming to hit the fan and it hits the fan in like a couple days, right? And then everything switches. I'm not there yet. And I could totally be wrong on this, but I don't think shit's hitting the fan yet. I know it sucks on a red day and no one wants to hear a lot of bullish stuff on a red day, but I think there's a lot of things that are still trending towards the right direction in the context of earnings and the macro that is not a leave the market entirely. Now, is this 2021 November where NASDAQ's at 16,000 and we fall all the way down to 10,000 and then everything corrects? Palantir goes to $6, Tesla goes to 103, Nvidia pre-split at this point or post-split would go to like, Nvidia would go to like from this price $46 around that. That would be the 60% draw to something like that. I don't know if the earnings justify that. I just don't know. So Palantir having billions in the war chest is looking really smart. 100% agreed. 100% agreed. Amid Amazon AWS backlogs 150 billion. Is that true? I'm actually not sure about that. I have to check. I don't think it's 150. I know the run rate on AWS is 100 billion. I don't know if the backlog is 150. I would have to look at the 8K to figure that out. But I don't think we have 150 billion in backlog. So the AWS is going well. That's the most important thing. And that didn't miss. If that missed, then I would say, all right, that's justified for Amazon to take a hit given the valuation. But 169, dude. I talked to a bunch of Amazon bulls before the earnings and they said 200, book it. And I was like, why? They were like, number one, they told me the margins would increase. Okay. That's why I hamped on the margins so much. Number two, they said cloud would beat, and cloud did beat. Margins didn't really beat, and then guidance took a hit, and then they missed on revenue. So those two things shot it back right down to 169. All right, that's it. So that's what we got. Let me do word of the day. I didn't do it in the morning, so let's do word of the day. Okay, this is a fun word of the day. All right, here you go. Word of the day is folderol. Folderol. Mere nonsense, foolish talker ideas. So maybe the narrative that we are still in a bull market is complete folderol and shit's hitting the fan and it is time to raise cash. Things are going to get bad. Or maybe all the bears that are coming out saying that they told everyone they're a bit too early, and that's a lot of folderol because Amazon just put up $148 billion in revenue. Sounds like a cough syrup. It literally does. Word of the day is fuck. Yes, that's a much better word of the day. Word of the day is fuck. Word of the day is fuck. Oh boy, oh boy, oh boy, oh boy. Did Meta take a hit as well? Meta was down from 530. Meta's at 497 after. Meta's still up 4%, but Meta is down. We are also due for the 10% normal correction. That's another good point, Mike. We are also due for that. We haven't had a 10% normal correction in the indices. We have had it in the individual stocks, but the SPY is not corrected 10% yet. Neither are the Qs. So we're going to need that. We usually have a 10% correction at least once a year. On average, it's twice a year. If you look at any year since 1950 in the S&P, we haven't had that once. Maybe that's what's due. And things change as we get the rate cut and we keep going. We keep going further. We had it in the Qs. What was the Qs? Well, we might have had it today. Qs, the peak on the Qs was 502. So, no, we're 451 until we have it in the Qs. 451 for a 10% from the top. And on the S&P, the top was 565. So you're looking at 508 on the S&P. So 508 on the S&P and 551 on the Qs. That'll give you your 10% correction. All right, that's it for me. I'm about to go live. The work still continues on a Twitter Spaces. If you're not following on Twitter, you can. I'm putting it in the chat. About to go live and talk about stocks again on a Twitter Spaces I do every Thursday for tech. So I'll be live for the next 2 hours in audio if you guys still want more of me. All right, thank you, everybody. Love you all. Appreciate it. We'll be back in the morning, 8:45 a.m. on the Market Open. Bye, everyone. Have a good one.